hear and see me, is it?
Yes, sir.
Yeah, that's great. Yeah, let's start from where we left last week. All right. We basically ventured into principles of credit management, and we were looking at, in the organization, different structures we were looking at, and how it is now. It is between bank and financial institution, different financial institution. This differs, but then fundamentally, it will be the objective will be the same. Like different structures, approval processes, relationship management, credit administration. What is the need for multi-layers? How delegated authority is given for different hierarchies? Who has the power to give the delegated authority? How it is flowing down? All that we discussed last time. Then different levels of committees when it comes to approval. Starting from the lending officer at the branch, at the regional management, and then up to the level of corporate management, and then executive credit committee, board credit committee, board level. How these approvals takes place, we had a discussion. Then I talked about the loan policy. This is one of the important documents we need to keep in mind. What is a loan policy, and why it is necessitated, and what the organization achieves through a credit policy, and what is the frequency in which it will be reviewed. All that we looked at. Then we spoke about a theory. Sometimes in many areas we use it, agency theory. Agency theory in lending, how it works, we looked at. Agency theory in management also, you must keep in mind. The board has the ultimate objective of running an organization. And then board delegates the selected powers to the management or executive management to run the organization. So that's where the management, the corporate management, acts as agents of board in carrying out the instructions given by board in running the organization in the way the board and the shareholders wants it. So agency theory in lending we looked at. And we came to these very basic concepts of credit appraisal. What are the things we are looking at while you are doing the credit appraisal? So we saw that these different mnemonics, different formulas being used, but end of the day, you are looking at a customer's character, capacity, capital, condition, collateral, cash flow, and all these things, and sensitivity, and all that. These are things which we were looking at. We were putting in front of even purpose. Character we were putting in front. So that is the importance of somebody's behavior, somebody's past behavior, somebody's pattern of availing loans and then paying in the past, its background. All that kind of reflects in the character of a customer. So we can't say that only individuals have character. Corporates doesn't have character. Corporates also they reflect the character of the management, character of the owner and the management, right? So the character is very, very important. That is put in front of, as a lending officer, we will look at security, what is the security, what is the purpose, but we put the character in before that, because if the character is bad, even if you have a good security, even if the purpose is perfectly fine, even if the cash flow is fine, still we will have problem in recovery of the loan. So that's the reason why the character comes in front. So keep that in mind as lending officers. If you are going and already working in credit area, or you are going to get posted in credit area, or even if you come up in the bank to any position, your credit knowledge is very important, because bank is about taking the excess cash from the market and then lending and making a profit. In lending, if we are not strong, if we don't have a strong culture, if we don't have sufficient controls in lending, a financial institution can go into trouble, which time and again has been proven in the market by the failing banks and failing financial institutions. So that's the importance of doing the appraisal, which we looked at, right? So capacity, capital, owners contribution, collateral, conditions, right? What is the condition which are sometimes beyond the control of the lending officer, in the cash flow, and then different mnemonics. This is Campari. Under Campari, what we look at gain, character, ability, margin, margin of profit, purpose, amount. In these, what I can, most importantly, I can say character is very important. Ability to repay is important. Our profitability also is important. And purpose of the loan, when you look at what is the purpose, without a purpose we can't give. People, lending officers, trained lending officers should be able to identify what is the purpose, whether there will be a diversion. How do you ensure that you are making the customer to use the loan taken to the particular purpose? And what is the safeguard? Insurance, basically here we mean about the fallback situation. That can be the security what we are going to take. Insurance against the possibility of non-payment. In case if the loan is not paid due to the mismanagement of the customer, or else due to conditions beyond his control, if the loan is not paid, what is the alternative for the financial institution on which they will rely on? That is the very reason why we look for a security. Security we take not for the purpose of loan to be recovered from the security, except in case of cash margin loans where you give against the deposits, and then customer wants the deposit at maturity to be used to pay the loan. Except in those cases, largely we take the security just as a fallback situation, just as a condition by which, just as a in a comfort level for you, so that if in case a customer may become insolvent or unable to repay a loan due to various reasons, not purely because he is a defaulter. In the case, he deliberately defaults. Somebody, if the character is bad, they will deliberately default. But most often what happens is that the particular product he is dealing with has gone out of fashion. Some alternative in the market has come and established itself. Due to COVID situation, business closed, and then he is unable to run the business. Due to the reason that it's kind of a seasonal type of a thing, and then which is going out of fashion. Various ways, various reasons due to that, a customer can become pushed into a situation where he can't pay the loan. That's where you look at the fallback situation insurance. Even then, auctioning a property or going for priority execution, these things we will look at later, is the last resort for a financial institution. We always will try to sort it out. We'll always will come to reschedule. We always will try to restructure a loan, and then try to accommodate the customer, try to accommodate the loan repayment to the current cash flow, future cash flows of the customer, which is maybe reduced or amended compared to the original loan, compared to the time at which we gave the original loan, right? Okay, so these are the things we discussed anyway. So we went at length to discuss different, 3Cs, 5Cs, CCC parts, and then parts. All these are coming around the principles of good lending. And one of the other important thing what I told you was a quality which a lending officer should have is the healthy skepticism. You must differentiate as a lending officer between you and your, like, you know about the insurance agents, how they will come and behave. Insurance agents will come and try to sell a policy. They will promise so many things, so much of things they will promise, and you will get a comfort level, like, I mean, any problem I can go to this particular insurance and then I have a claim and all that kind of things. They give, but ultimately when there is actually a claim, especially at a personal level, corporates have their cloud, somehow they will put the pressure and then get the insurance claim paid. But at a personal level, if something happens to somebody, going and claiming the insurance is a totally new skill, totally new task. It's so difficult. So that's the way the insurance agents will, that's because insurance agents get a good return from the premium, from the first 3 premium also, something that, I mean, 40% return comes to them. So, like, I mean, for them to get that, I mean, after getting the bonuses, of course, they will run behind new customers. Hardly they will have time to sort of spend on the problems of the customer in the future, because which is not rewarding to them. So you would find, especially when we are taken personal kind of insurance and all that, these issues are there. People finding it difficult to get the claim done. Insurance company will come out with so many clauses and then say, you haven't satisfied this, you haven't satisfied that, due to that we can't meet the claim and all that. But then in banking, bank lending officer, it's a job which is a much more difficult job than that. Lending officers cannot go to the customer and then promise everything. This can be done, that can be done, and all that promise, and then try to sell a loan. You always should have a healthy skepticism, which we discussed, is that customer will say so many things. Always you must suspect little bit of rational thinking, and you're challenging that whether it can be is important. That is the very reason we were discussing that we are looking at, even if it is a security, we don't go for 100%. Even if it's a lease, we try to stick to a particular percentage. Even if a gold loan, which is highly liquid asset, where if the customer defaults, you can auction it and then recover the loan. Even then we have a percentage. We don't go beyond the percentage, right? As much as possible, we try to keep a margin. Housing loan, commercial loan, what is the margin and all that, we keep it. So while assessing also, we don't take the word of the customer that he has so much of cash flow, from that he will be able to repay the loan. Monthly installment can be met from the cash flow. But you will always try to justify whether the cash flow is correct, and then you will try to take a margin out of that. We don't say 100% will be used for loan repayment. We try to say that, I mean, this cash flow is there from that, okay, within 60% of the usage of that excess liquidity what you will have from the profitability, you will be able to meet the loan installment. That kind of a thing. That is what I meant by this healthy skepticism. That is doubting whether this can work, for basic reason that customer will always be talking about his ideal condition. So many a times ideal condition is like, it's good to talk, but it doesn't work. In reality, there are differences. That's the very reason. It's one area, one good quality, which the lending officer should possess. So we also looked at if the risk level of a proposal is high, means what you do. The risk is high. So bank risk levels are high. By lending, there can be a situation where the customer may not be able to pay it back. So bank cannot go and meet that amount of accommodation. So we look at ways and means of increasing the borrower's contribution. You say your contribution should be high, or else according to your contribution, your project you will downscale a bit, right? You are going a bit high. You'll have to downscale your project to this level. Still, you can generate, and then in future, with building up of the equity, you can expand, something like that. So increase the borrower's contribution. Like we'll ask for additional security, better collateral. So we'll try to strengthen up the security cover, or else increase the equity and then decrease the exposure. And when the risk is high, normally the interest rates, of course, what we charge will be high. So you know that compared to your normal other facilities what you give for the customer, credit cards what we charge. Credit card we charge a higher rate. We're charging even up to 28%. Now the central bank has capped it to 18%. You must think what is the reason why, while we are looking at even personal loans and all that at 10% level, why we should charge credit cards 18%, right? We are giving to every customer, they are using, and then just like any other loan, we are charging, and then but then we are charging a higher rate. So that's about the risk. But the credit card risk is very high. Where we give this almost about 55 days credit cards interest free we give for them to use, and they are after only if they use the credit limit. If they don't pay the due date, on the due date only, interest accrues. So the risk is very high in recovery. If for a credit card, if a customer, many of us will do that, we don't want to pay interest, we'll use the credit period and then pay it off. So honestly, for a financial institution, for such a regular customer, they don't make any profit. They don't make any profit because money is not lent. Only credit period is used by the customer, and then on the due date he is paying the 100%. Good customers will do that, but it's not remunerative for the financial institution. So financial institution always will see ways and means of making people to go for advances payable over a period of time so that they can get interest. So this is the reason why, based on the risk of the credit card, rates are kept at higher level. Personal loans, high, risk is high, right? So due to that, rates are high. Some of the corporate loans, some of your blue chip companies to whom you are lending, you will be giving even at your cost of fund also you will give, or slightly keep a margin and then give. The reason is why? Because the risk is low. Such customer will not easily default, right? They have a reputation to defend. So in the market, competition is very high to lend to that kind of a customer, so that we will give it at a lower rate. These days, you know that in the market, corporates are enjoying facilities at 5% or lower. Short-term facilities are enjoyed by the customers at 5% or lower, right? The bank's cost of fund is almost about that area. We are giving still that 1 year fixed deposits and all. We are giving a high rate until maturity, and bank's cost of fund is just about that this one. But still, for all, we are lending because of the competition and excess liquidity in the market. So such is the clout what a corporate will command, right? That is because of the risk level is low, perceived risk level low risks. And then we also spoke about lending officers' knowledge of market. So lending, I told you last time also, it's an art, basically. Included science is included, where you innovate new ways of assessing the customer. But then it's an art for you when you are looking at a customer. Based on your experience, there will be a gut feeling coming. You will have a gut feeling whether what is this business, okay, is in this trade. So whether at the level explained by the customer, whether he can operate and whether he can make a profit, there is something. But over a period of doing credit, you will get a feel of it. Then, of course, you will work on your financials. All different risks, what we will discuss later, will be looked at and then assess the customer and then come to a position there that, okay, from his earning before interest, taxes and accruals, this customer, yeah, from what EBITDA he should be able to, repay the loan, service the loan, and you will have a steady business in future. All that you will come with the financial analysis. This one, but as a trained credit officer, trained lending officer, you will have that feeling, right? So continuously, so you need to continuously will have to update. If you are a credit officer, you are reading the daily paper is a must. You must know what's happening in the market. You're listening to this financial news is a must. You must see not only in Colombo, not only in the country, but around the world also what's happening. You must know that what's happening to the LIBOR, what's happening to US interest rates, what's happening to the gold rate. Gold prices are going up, whether dollar rates are going up or down, whether LIBOR rates, what is the future of that? Now they are talking about LIBOR rates will be replaced by something else in 2022. So what will happen? We are charging interest based on LIBOR, how it will behave in future. So this kind of financial knowledge is very important for you all. So your reading is very important. Wherever you are, you may be in Colombo, you may be in Gaul, you may be in Kandy or Anuradhapura, wherever you are, you have access to the news. So you must have a habit of going through the news and collecting information. So as a lending officer, your knowledge of the market, local, international, your knowledge of the regulatory environment, how the central bank is changing, how the central bank is bringing in new circulars, what are the new changes, what are the import policy changes, what are the export policy changes, what are the kind of PLR changes on a weekly basis. All this you must have the kind of, I don't say you have to be a master in there, but be aware and be current. That's very important. Any questions? Any questions up to now? Are you all comfortable with this? Yes. Okay, how many? 48. I don't know how many of you are there. 48 students. But normally they talk about hundreds. People don't participate even on an online class, right? So when you are, something I used to repeat is that at the level of the postgraduate learning, it is a process. You go through a process, be it in class, face-to-face class, or be it online learning, whatever. What you can grab from the tute, I would say maybe about 20% you will grab from the tute. Maybe about 80% you will get from that discussion, deliberation, and lectures. So that is very important for somebody. That's what I say. say if you are going to I used to say you are going to maybe Gaul, or maybe you are going to Jaffna, somewhere. When you're going, if you want, you can take a flight and then go and land there, straightforward land and go and see and come. But then when you go by the route, you have 6 to 9 hours of traveling. Let us say the amount of things what you see, what you learn about the, like, area, the experience cannot be replaced by, directly going and landing and seeing the patient coming. So the learning also is like that. The process is important. In the process, you learn a lot. That's why 80% of your learning comes from the process. So involving in the process, attending and involving is very important for your learning, right? So many of the students have this particular thinking that, by going through the tudes and like kind of, before, just a week before the exam or a couple of days before the exam, I will get through the exam and all that. Even if people get through the exam, that exposure experience will not be there. That only keeps the people in good state in going up in their career, which is something I have learned by experience. I myself used to be a fan of these not learning, and then at the last moment are going through and then getting through the exam. That kind of a behavior I also had. But then when I see this, I really felt the futility of that. It's futile. Actually, it doesn't really pay off for us in our career. In our career, if you have chosen a kind of a course with lots of sacrifices, especially at this postgraduate level, you are sacrificing your time with the family, your personal freedom, your liberty to be, doing something what you like during weekends, and so much of sacrifices are there. Children, they are sacrificing their parents' time, right? The parents, instead of spending the time with the children, they are spending on that should be rewarding in every sense. So making use of it is very important. You must make use of it, and then which should really contribute to your career. That's what I always preach. Okay, we were talking about structuring a facility. Structuring a facility, of course, I told you that you look at what is the amount actually required, what is the purpose for which the facility is required, whether it can be a housing loan, whether it can be a personal loan for some purpose, whether it can be a commercial loan where you have a composite loans, like you give overdraft, import loan, pre-shipment loans, ideals, many things you can give. So these structures, when you are doing, you have to be very. Somebody wanted to speak to me? Let me see, anyone has sent any? Okay, so that's what we were talking about. The purpose for which you are structuring a facility, for the amount what you are like, and then the what is the timing of the cash flows, what you are, if it is a project loan, what you are structuring, you will know that, what is the gestation period, how long it will take before the cash flows coming in, where you need to put up a factory, let us say, and then put up the machinery, set it up, and do the production, and then come to commercial production and selling and getting the sale proceeds in. So that's the timing of the cash flow. And what is the financial position of the customer? How do we price yourself? How is the risk and reward payoff is being looked at? All these kind of things are necessary for when you're structuring a facility. So that's what I was telling you, that in structuring, if you don't correctly identify the need of the customer and correctly give that for a purpose which is not more than what he requires, or which is not less than what he requires, then only the success of the particular project or success of the investment can be achieved. Otherwise, what will happen is that When you give less also, people will go and borrow from the market at a high rate, and then high risk borrowing they will go for, and then their cash flows will be disturbed, right? So that loan can eventually become bad. Like that, if you give more also, people will take it and then use part of it for their other non-revenue generating expenses, like basically like the way in investments, like in vehicle, expensive vehicle, and then going and getting a expensive property, or like going on a rent to a property which is high rent and then no return. So that kind of things, customers keep on doing that because to show others that they have a very high lifestyle. End of the day, that will be impinging on your loan repayment. People will do that. Finally, it will not be generating any revenue from the business, but the revenue generated will be less than expected. Then he will have problem in servicing the loans, eventually pushing them towards other issues. So structuring, that's what we were discussing, is very important. Credit appraisal. You need to do a looking at the purpose of the facility, you need to do a in-depth analysis of the customer's profile and his transactions to be performed. For that, you will look at all the past, what he has done, future, what is projected, currently at what level he is doing, and whether what he says, what he claims in his request about his repayment capacity, whether it is reflected in the figures from his turnover from the account. You will look at the turnovers. You will see how much of debit turnover, how much of credit turnover, whether the debit turnover with that, can you justify that, whether somebody has the kind of, the limit what was established earlier, whether that justifies. For example, for you to tell, let me say, someone says that I have a credit period given to customers, about 1 month credit period I give. So if he is giving 1 month credit period to somebody, at the end of, after giving the product, at the end of 1 month, he should be getting the proceeds. Let us say you have given working capital facility of 1 million. That means a minimum of 12 million turnover should be there for a year for him. That's the basic way we look at it. 12 million turnover means 12 times he has turned it over, right? He has taken the loan, he has settled. So what it means is that I would like to show you in the board, right? Can you all see the board?
Yes, sir. But when you start writing the board, then only we can realize whether the board is clear or not.
Okay. Now the blackboard only I will show here. They haven't given me the pen to write on the this one. But can you see the blackboard, or should I wait? Now I hope I have a problem, because the showing the blackboard option is not coming to me. All right, I will ask them about that and then do that. This particular thing, of course, I need to have a pen to write so that you all will see that. Okay, now what I am trying to say is that when you are say 1 million, you are giving a overdraft facility. So you know that if you draw a graph and see, it will be at a zero level, right? X and Y coordinates at the zero level, and then it should go up to you know, the 1 million overdraft level they will use, and then at the end of the 1 month, you know, ideal situation that customer gets the sale proceeds, again it comes to 1. So you will have this kind of a spiraling kind of a graph where you will find that, I mean, customer always make use of the limit to the maximum, and he kind of make use of the limit and gets the sale proceeds on time. But what happens is that about 70%, 75% of the time, customer takes an OD. OD will come down to let's say 1 million means 800,000, 900,000. It will come down, go to 1 million. They will ask for excess of 1.5 million. Like they will be operating at that level. Many a time this happens. Maybe about 25% of the customers only will properly bring it to credit and then use the OD limit and all that kind of thing. But many people will do. So what it denotes is that customer actually use the money for a capital investment or some other purpose, stuff, so whatever, which actually should have been used using a term loan, but overdraft has been used. So due to that only, the overdraft is, we call it hardcore. It doesn't come below, let us say 800,000. If it doesn't come below 800,000 on a 1 million overdraft facility, if the overdraft remains at 800,000 and then goes to 1 million, 1.5 million, comes down to 800,000 like that, that means about 800,000 we call it hardcore. That means 800,000 of the amount which is invested is currently not giving back the return to the customer. That means it would have gone into some sort of a capital investment, or like, I mean, you know, some long-term, mid to long-term investment which is not giving him return, which is not coming into the account. That's what we mean. So the customer's risk profile, this way we will have to look at. But exactly is that if we ask for an enhanced level of facility, whether it is justified, that's very important for us to see. So depending on it, suitable facility package of facility will be structured from a simple thing of giving us a personal loan, housing loan, any credit cards and all that, to the level of giving a composite loan which will have a structure. Overdraft facility will be there, short-term revolving short-term loans will be there, mid to long-term loans will be there, housing loans, like, I mean, it's a mixture of loans. You will, that's a package also is being done for bigger customers. So you will have to, while you are doing the credit appraisal, you will do the justification of the amount and facilities requested. Justification of the purpose and source of repayment. We were to look at these analysis of major risks with mitigants. We looked at, we spoke about financial risk. Financial risk is where that the customer unable to, due to the financial activities, the customer becoming unable to generate the cash flow but yes projected, right? So for that only financial risk, we have so many. We will look at the ratio analysis. What are the ratios? We will look at to assess the financial risk of the customer. How much he is leveraged, how much of loans he has taken, what is the loan repayment, whether he should be able to use the current cash flow and then service the loan. So future cash flows, how much it will come, and then with that he will service the loan. So currently, how much of short-term assets he has, like I mean, what is the working capital? What is the working capital currently? Yes, you will look at short-term assets minus short-term liabilities, and then see that, I mean, how much is there, which will accommodate for him to pay the current loans. I mean, various ways we will look at the financial risk. We'll analyze and see. You look at the financial risk of the customer. Then the business risk is that in the market, how the business is performing, what is the product in which the customer is dealing with, what's his reputation, whether the product is a stable product, whether the product, whether there is any tendency of product going out of the market, what are its alternatives, whether it can be replaced with something else, whether the customer will have sustainable business, whether customer is properly competing in the market, whether competitors are eating into the market, and then whether there is a possibility of customer going out of the market. All that will be looked at from the business risk. And then the market risk also, when it comes to, I told you, two ways of market risk while you are learning, you must know. One is the market risk for the customer's market, business risk and market risk. The other market risk you will look at, in the Basel II, we looked at in the pillar 1, credit risk, operational risk, and market risk. That, of course, looking at the market risk of the assets of the company, assets of the bank, its volatility. We looked at the whether it's the foreign currency holdings, foreign currency assets and liabilities, your deposits and advances in foreign currency, and then gold positions. These areas we looked at in our calculation for market risk. So that is market risk for as far as a financial institution is concerned in the assets and liabilities. That's a market risk. That's different. While you are looking at the treasury operations, you will look at that market risk. But when for a customer, is market risk is in the market is standing. You will look at its market, what is the market for his products, and then how he is going to serve. So business risk and market risk are connected risks when it comes to customer assessment. And then management risk. You look at the management. A lot of Sri Lankan companies, you will look at, people start from a very small level, and then they come to a level of a bigger companies, mid-sized or big-sized companies or conglomerates. Conglomerates means it's bigger, group of companies. All that, where always you will have to look at the management risk, because currently who is managing the business, whether there is a structure in managing the business, whether it's a sustainable structure. If you find that father built up the company is doing really well, and then now the second generation is taking over, son actually has not gone through the problems what is faced by the father in building up such a big company. So he waywardly takes decisions. He gets into businesses which the father will never get into. He goes thinking that I'm a graduate, overseas graduate, so that I can venture into areas which are trendy and all that, without really understanding the depth of the problem. And we find lots of businesses, second generation businesses, falling into trouble because of the maneuvering by the second generation, the sons. They are not respecting. They think that my father and my father's colleagues, they are not educated. They don't know about the world. They don't know about the business. They don't know what things can create a lot of, with risk we can earn. All that, and then they venture into. So we come across a lot of businesses like that also in the market, where second generation messing up with the first generation's hard work. So that's about the management risk. But there are many companies where they do what happens is that in globally also there are a lot of companies, big companies. What they do is they ensure that a professional setup is put to the management. They will see tried and tested executives at the corporate management. The CEO will be a person who has come through his ranks, and then at the same level elsewhere he has functioned as CEO. They will hire him and give him the liberty to run the organization, and then they will have very well trained professionally qualified, professionally experienced CFOs, CIOs, and other marketing executives and all that. They will hire a group of people to run the organization professionally and give them the kind of a liberty also in taking important decisions, and by which you find Bigger companies, even Google and all, you will find Sundar Pichai. You can see Sundar Pichai has taken over and running the company. The owners are basically disassociating with the company. I mean, they have minimum involvement. Like whether it is if you take Microsoft, or whether you take Google, or whether you take like what can I say? Many companies, Pepsi Cola and all that. I mean, the guys are all owners are. I mean, those have gone through many generations. They know that, I mean, hand over the company to a professional organization and then have minimum control, and then have some important controls coming to them. With that, to see that, I mean, the business is really doing well. In Sri Lanka also, there are many companies like that, professionally run companies, where it has gone to the second generation or third generation, which is doing really well. I mean, there are many other companies also where the second generation has messed up with that by their kind of unnecessary involvement in the management, and then trying to run the company themselves by the second generation or third generation. So this is about the management risk. So that's why when you are assessing the management of a customer, especially a non-personal entity, a partnership, or a limited liability company, corporate, which is a listed entity in the stock exchange, that you will look at the management, how the management is being done, right? How professionally the management is run. That's very important. That is a make or break game. That is the very reason where you will find that financial institutions also, many of the finance companies, which when it is taken over and run by the families and all that, they mess up. And many finance companies fall into trouble also because of that. Somebody wanted to speak? Yes? Anytime, please interrupt and speak. And so that you will, you will not have the boredom. You will not be bored, and that will be very good for, having a discussion will help everybody else also here while listening, because it's, holding on to your mobile or your laptop or listening to somebody for such a long time is not a easy task. So due to that, please interact. So interacting is interesting. Like what I told you, discussion doesn't mean that only knowledgeable people should do, especially in a class environment. I'm happy even getting questions which are pretty obvious, or which you may think that how idiotic question somebody is asking, even if you think that, I mean, it's not idiotic anyway, because somebody is being frank that anybody has a right to know what they don't know. So even the brightest people may not know some basic things. So it is, if they won't know, they should get to know about that, because I mean that's the thing. So many of the things what you know, maybe I don't know. So I should not act as if I know everything and then say that I mean try to always lecture and all that. I mean, it should be a healthy discussion, so that we share the knowledge, and then we both, it's a win-win thing for both of us. So don't hesitate. So when you feel like talking, that's what I say, at a postgraduate class level, it should be a discussion session. It's not always a one-way traffic where we deliver and then you listen. So keep that in mind, students. Please, feel free to discuss. Right, management risk, of course, I have seen at various levels how it works well and then how it doesn't work well. Where sometimes it works the other way also, where the father keeps say for example a CFO accountant who is not qualified, but he knows everything about the business, but currently the company has grown into various businesses, into various, so it's a little complicated in keeping accounts also. Consolidated accounts they have to prepare, entity wise they have to prepare the accounts. The current accountant is not capable enough of doing that, He is not capable enough of having properly coordinating with the auditors and getting things done. But because he is trustworthy, he is continuing. That also is harmful, actually. So they will, they will stunt the growth of the company. Because they always think from the point of view, like, we had one company and then we were doing this, and then why to do that and this. Always they will try to put stumbling blocks, and then always they try to secure their position and wait. So this happens in many businesses. They are okay. We sometimes call it they are harmless people. They try to do something, but then for a growing company, it's useless. So the business risk, the management risk can work in many ways. So management risk is very important for a lending officer to assess. We looked at the structural risk. We looked at security risk, of course. So security is basically will be looked at from the point of liquidity to illiquidity. So liquidity is highly liquid assets is what you can turn into cash faster. So if you are having cash margins, you can turn it into cash faster. So that's liquid assets, liquid security, which is very good. Basically, the problem is that customers will not be in every customer will not be in a position to give that kind of a security. Now, if you take, let's say, treasury bills and treasury bonds and all that, you keep it as a security and lending, those also can be turned into cash. And then let's say the next line is like, we spoke about deposits. The other one is these. And then you look at shares and all that. Say you have done a cash margin, margin trading. At the beginning, we were talking about the margin trading, where you keep the shares of a customer in a kind of a common account, and then if the bank wants, bank can sell the shares and realize for the advances what the bank has given. So that also, like, you can give the bank can give the instruction to the stockbrokers asking the shares to be sold. The customer's shares, which is in a common CDS account, it is maintained with the bank, and bank can tell the loan is to be recovered, loan is going bad, or share prices are going down. Bank has the right to go and tell the stockbrokers to sell the shares and then recover the money and then get it to the account. So that is also liquid. So then shares and insurance, if you have taken insurance as a security, surrender value of insurance, we take. Surrender value is that when you surrender the particular, so you ensure that the particular insurance policy is updated and kept, and then when you ask for a claim, at that point of time, what is the surrender value? What is the value at which the insurance policy can be redeemed? So that's called surrender value. So at that point, the bank will write to the insurance company telling that we are going to redeem this particular insurance for the advances given to the customer. So the surrender value, the insurance company will look at, and then that amount will be paid to the bank. So that also is a fairly liquid thing. You look at the gold. Gold is very liquid. Customer doesn't pay, and you auction the gold, right? You go for an auction and auction the gold and recover the loan. So that also is liquid. Now, when you come to property mortgages, say if you have the first party mortgages, if you have taken the customer's property has been taken as mortgages, and given the fact that we are satisfying the central bank's requirements on going for parate, which we will look at later, we can go for a parate execution. So that is circumventing the legal course. Legal cases, you will have to file a case, and then through the court only you will have to sell the property. But here, parate execution, you directly go and sell the property by passing a resolution at the board level and going for by advertising and then going for a parate execution. So parate execution is when it comes to a property, is a faster way of recovery. So The security risk, you look at the risk different. Now, Parata execution, you can go for if it is a third-party mortgage, if it is a mortgage which cannot be sold by Parata, you will have to go to a court case. So you will go to a court case, and then it might take a longer period to recover the loan through a court case. When the court case will be ended and then order will be given, recovering, so that of course is a bit of a long-drawn affair. Then the other things are like, we always have a famous security. We go for stocks and book debts. These, I would say, most of the time it's a namesake securities. So we take a mortgage over stocks and book debts. What is the stock customer has? What is the stock? What is the book debts customer has? And we take a mortgage over that. So that gives a right for us to get those cash flows to the bank. But practically, it's so difficult to ensure. Practically, like, we are relying on customer to do that. Morally, we have a security, right? So those securities are really difficult to realize. So, but famously, when it comes to corporate lending, a lot of things we do like that: stocks and book debts, mortgage over stocks and book debts, mortgage over machinery. When you take the machinery, let us say in a factory, garment factory, the machinery is there. So we take mortgage. So as we procure the machinery, and then as the machinery is fixed, what may be the price, and if it comes to a level where customer cannot operate, and then you have to sell the machinery, the realizable value will be much, much lower, because you won't find a market. You won't find a ready market where somebody will come and say that I will buy this machinery at 100%. If the value is 100 million, I will pay 75 million and buy. No, you will not find. It always will be less than 50%, or lesser than that. So machinery also we take mortgage, but still the realizable levels are much less. So that's why when you are taking coverage under these things, there is no point in going for 100% or 80% or of the value and all that, because the realizable value of these kind of security is much, much less. When it comes to vehicle, yes, vehicles are so they have some market. So when you're going for leasing, you can repossess the vehicle and then resell and all that. Most of the time you will be able to meet the loan amount. Why? Because from the time the vehicle is bought, the lease amount is being repaid on one side. On the other side, sometimes the vehicle prices also go up. In the recent past, the vehicle prices in the market have gone up. So what happens is that many a time that's a phenomena in Sri Lanka, where many a time the second hand in the market, by selling, people sometimes make profit over the cost at which the vehicle was purchased. So vehicle, of course, kind of liquid kind of asset, I can say, but not the stock and book debts and machinery and all that what we take. And in corporates, we do take security like negative pledge. It's a term. What does it mean? Negative pledge means you give an undertaking to the lender that my borrowing from other banks will be at par with your bank. That is, I will not give any security to the other bank also. That's the negative pledge. I will not pledge any of my facility to other banks. That's negative pledge, right? So in corporates we do that because we want to ensure that the customer on clean basis means without security, we on clean basis lend to a particular corporate, and we try to ensure that this customer, he can go and he has the reputation in cloud to go and borrow from other financial institutions. But only thing we try to ensure that when they borrow from other financial institutions, they don't give any security. In that case, if they give a security, then our standing will be down. So due to that, we try to get an assurance from the customer to say that, no, we are we are not giving any security to anybody in the market. So you also give clean basis. So that's called negative pledge. You get a letter call like that. I mean, a letter of assurance from the customer telling that we are not going to give any security to any of the firms. That's called negative pledge. So these are all different. I mean, negative pledge is not, it's only a comfort. That's not a security basically. So the security risk, when you're analyzing these things, you will look at what is the security you have taken. As a lending officer, while you're assessing, you will say what is the security risk we have taken. So in this particular security, so what are the pros and cons of this, right? So that you will discuss. So these are basically what is the risk and what is the mitigant. Basically, that's why you will say financial risk also, what is the risk, what is the mitigant, how you try to. So you are trying to be very balanced in your assessment of the customer. So you are talking about the risk and then you are talking about the mitigants. These risks are there, we are aware. The problem is when you find out that somebody is defaulting, that you haven't identified the risk. But if you find that somebody is defaulting and you identify the risk, but there are mitigants you have spelled out in your proposal, that's a good proposal. That's the reason. So you identify a risk and then you find, you mention about the mitigations. So that's important, right? That's about assessing the different risks. There are many other risks also down the line. When we go, we will look at important risks are discussed here. Yeah, children, go ahead.
Can you explain it, structural risk again?
Yeah, structural risk. Thank you. Thanks for asking the question. The structural risk is you structure a facility, right? You structure a facility. Now, it's no brainer when you talk about a housing loan, a personal loan, a one-off loan you are trying to give. That's not a problem. A term loan to buy a property, a commercial property, say a term loan to kind of put up a factory. So these are no problem. You don't have a structural issue. You just assess and go ahead. I mean, there's no problem regarding structure. The structural risk comes when you are structuring a facility for a customer and whether you have taken everything into account and then structure the facility. Now, for example, let us take a customer like this. You have a importer of steel, let us say. Importer of steel is importing steel and distributing. So he's distributing the steel to the commercial, like factories and all that, constructions and all that, or residential constructions and all that. Let us say this is a typical business from almost it, right? Wholesale importer of steel and distributor. So they will have huge stores. They will have, so they will ask you, for my import, I want to have a LC limit. Okay. Let us say that, you need to have $5 million worth of LC limit. And then they will say, I want to have import loan limit, because from the time I import, I will have to sell, I will have to give 3 months credit period to my customers. It will take 3 months time for me to turn it over. After importing and after clearing the goods, it will take 3 months time for me to clear the goods. So give me a import loan, 90 days import loan you give. So import demand loan you will have to give. Then he will say, when I import, I want to say the exchange rates are very volatile. Now it is one day it is 185, one day it is 190, 192, like it's very volatile. So the moment I go and open an import LC, the moment I know that when I have to pay the LC, I need to book forward contract to pay the loan. Let us say $1 million he has imported. $1 million if he has imported, he clears. He knows that the documents are coming. He has to clear in 30 days time. So in 30 days advance, he can, book a forward contract. In 30 days, I want to have this particular exchange rate. They will ask 1 month forward, how much you will charge. Let us say right at the moment, the exchange rate is 185. Now, the bank may say in 1 month, if you want to take 1 million, that is to settle that LC, because 1 million you will have to settle the OCs, this one. So, to settle that LC, we may give import loan in rupees, but here the dollar he has to buy. So, dollar rate, let us say the bank is giving 1 month forward contract on this particular date if you are using 190. So, that's a forward contract, right? So he will ask for a forward contract. Then he will say, to keep my steel items in Colombo, almost it, I can't keep it out. I'm going to build I have a land, I want to build a warehouse. Give me a loan to build a warehouse so that I will keep my steel. So you have to look at a 50 million investment on building a warehouse. He has a land, and then, okay. Let us say he's buying a land and putting up, so altogether 50 million. So there are so many. Then he says, for me, working capital facility, you give me overdraft facility. I need to have the working capital facility on day-to-day running because I also in the market also I buy and sell. Whenever somebody importing, he can't clear the goods, I use my working capital, I buy that and then sell also. I make a profit. So I want a working capital. You say, you give me 100 million working capital, right? 100 million working capital. So now you see, you have many facilities in your hand. Number one, you have to give a working capital facility, 100 million rupee overdraft, and then you have to give a $5 million, let us say, import LC facility, and then you have to give a import demand loan to retire the LCs. You will have to give a forward contract. You have to give a term loan to build a warehouse. So you find you need to do a package to the customer. So you need to structure looking at the customer's requirement carefully and structure. So what we mean by structural risk is that, say, actual requirement to go and build up a this one warehouse in the outer part is only 50 million. But customer asked for 100 million, and then we went and put 100 million, this one, the lending officers assess and say 100 million needed. You put 100 million. The customer wants only 100 million working capital facility. Because you want to achieve your targets, you think the customer has enough of assets, you go and put 200 million. And 200 million overdraft facility you put, okay, your import lines, LC and other things are okay. LC, import loan, forward contract and all is okay. But in your overdraft, you have given 100 million more. In your term loan, you have given 50 million more. Let us say. Now, once it is approved, let us say the financials are looked at and then it was approved also. The customer, he never really wanted 200 million. You gave 200 million. Customer, according to his requirement, it could have been satisfied with 50 million term loan, but you gave 100 million. So he has 150 million excess fund. Now what happens is the customer, 150 million, he can go and put into share market, he can go and buy expensive car, he can go and buy a good property which he normally never intended to do. Because he has cash, he will go and invest and show a high lifestyle. He can do that. Now, he can go and now the share market is sort of very speculative. People are not keeping the money in the deposits. They are going and putting in the share market because no return in the deposits. So you can go that 150 million, you can go and invest in the share market thinking that he can make a very good return and all that. Now, what happens is that in risky assets, so in non-revenue earning assets like house and vehicle and all that, when people go and invest the money which they have taken for working capital, that will not give a return, but they will have to pay the installments here to the bank. They need to service the loan. Now what happens is there's a cash flow projection will be a problem. Cash flow projected for when they are investing this much, that much of flows will be there, they will service the loan. It may not happen. Slowly he will find it difficult because he has gone and put his working capital into areas which is not really returning. Now, like if he has gone and bought a property you cannot sell it easily, and then it is not giving any return. You are talking about capital gain after so much of years. And share market can go down, even capital can be eroded. Vehicles, it's only a ego massage. It doesn't return anything. Then what happens is that he will find it difficult to service the loans, right? You have a composite loan given, he will find it difficult to service the loan. Now, customer has fallen into trouble in servicing the loan. Whose mistake is that? Is it customer's mistake or your mistake?
Oh, but mistake.
Yeah, our mistake, right? Yeah, it's our mistake because we should have. It's our responsibility to see that we basically, assess the customer's requirement and then give only for his requirement. When we give beyond his requirement, then it's a problem. Then we ourselves go and put the customer into trouble. We put the customer into trouble, and then we run behind, then recovery action, it is transferred to recovery department, and then we try to reschedule, we try to restructure. Customer will go through agony. The basic reason is our lending officer's problem. Lending officer thought that, okay, this is a customer here, I can give 150 million more and achieve my yearly target, so that I can get my bonus, right? So that you must clearly understand as lending officers, as bankers and lending officers, you should clearly understand that is something we will have to be very careful. So a lending has to be to the purpose required, and lending mostly we should try to ensure that it given for the particular purpose and it is applied to the purpose fully. If it is not applied to the purpose fully, if it is not if it is diverted elsewhere, then end of the day, it will be the agony for the bank as well as the financial customer. Understood?
Yes, sir.
Right, that's great. Any other questions? Any other questions? Normally, girls don't ask any questions. In my normally face-to-face classes, what happens is that girls ask a lot of questions. Now, I hope that ladies are also getting into a shell. So we discussed this, the track record, past history with other banks. Now, those days we had something called, what do you call it?
Status report.
Status report. Exactly. Thank you so much. Status report. We call status report. What happens is that that's an interesting thing. Now it has gone. It's not being used. We write for the customer and ask for a status report. Now, while let us say a status report asked from us, we write it. We put the customers also, like we put the asterisks and then say this customer. And then we, in a very non-committal way, we'll say, enjoys facilities, enjoys regular facilities on a secured basis, no delinquencies, something like that. We give in a kind of a way so that we are, because we are also under oath of secrecy, we are not supposed to give our information to third parties. But to safeguard, we just, but bank to bank, that understanding is there. So we give status report. So status, even before the crib report became very important, the status report used to be there. You used to get that. So that gives the status of the particular facility with the bank, but in a kind of a concealed way, so that that financial institution cannot be held responsible. Okay. So that status report is not currently being used. Other than that, of course, the track record, we'll have to speak about the track record, his past history, history with other banks. Now, of course, I mean, what happens is that you have your colleagues in other banks. So even without, writing and asking, when you have the colleague, just informally also, we do check with them. This customer, only in case where, in a hostile manner, when you want to acquire a facility from other bank, I mean, we don't ask. But otherwise, just asking for. How about this customer? Like in a very, without revealing much, without giving more information, try to get it also. Those are informally, those are done. In a way, I would say that's healthy also. The things that the financial institutions in the market should have a better understanding among themselves, so that they safeguard each other against any unscrupulous elements. So much so, even at our level, we do talk to the people at our level to, on various things, and find out, and then in implementing, like in running operations and all that. I used to check with say DGMs of Sampath in HNB and all, what do they do, and the MDs of those companies. And that understanding will be there, has to be there basically amongst the banks, so that you are not isolated in your decision making or in your commitments. So that's about looking at the customer's past history, history with the other banks, and CRIB report. About the CRIB report. So Credit Information Bureau, where basically we look at the customer's information is given, and then we analyze and take it. I mean, how much of performing and how much of non-performing loans are there, what kind of a check returns they have. You have a card crib also, where the card defaults are shown. All that information will be useful for you in sort of assessing a customer, evaluating a customer.
Sir, I have a small doubt.
Yeah.
Without salary undertaking letter, can we grant personal loan is correct or not?
One sec, please. Can you repeat it? I'm not getting you. Right. Yeah, please repeat.
Without salary remittance undertaking letter, can we grant a loan?
Without what did you say? Without
salary remittance undertaking letter for professionals.
No. Without salary remittance to give to professionals. That's what you are asking.
Yes.
Without salary remittance to the account, whether we can lend to the professionals. That's what you are asking, right?
Yes, sir.
Right. Correct. Now, okay. That also your comfort level. Normally what we ask is that salary you remit to the account. So that ensures that self-liquidating nature of kind of a loan recovery. Because if the salary is remitted, we know that salary is remitted. The salary remittance to an account gives a host of information to you. Number one, what is the salary? Number two, if he has borrowed from the company also, you will get the net salary remitted. Then if there are any repayments are going, from that only repayments will go outside your bank. What are the repayments, you will know. Then you will know that his spending pattern on what he is spending, and then what kind of a month end you look at the debits. You know that you can analyze the spending pattern, and then say that whether he has the repayment capacity. That information you will get, and whether any other remittance money coming from outside to pay the loans. So whether the customer is rolling now, whether the customer is actually his repayment capacity is low, is spending more than his income. All you can see that, because if the salary is not sufficient, if he is getting money from elsewhere, probably is rolling from somewhere, is getting it paid. So these are the good parts of having the salary remitted to your account for lending for the professionals. because professionals also these days, the problem is that, whether professional or non-professional, the problem is that they are overspending. Because we are the culprits. We go and sell and sell. I mean, we just say that, I mean, you know, lifetime your card, so you don't need to pay the monthly annual subscription. You don't need to pay the annual fee. Here, this is free for you. That is free for you. Take it. And somehow we try to sell the product to the customers. Now, what happens is that people are, if they are not disciplined enough, whether professional or non-professional, they are into the habit of overspending. They spend, basically what happens is that they borrow and then roll it. And so the risk of not getting the salary is that the customer, whether he's rolling, whether his salary is going elsewhere, he's taking loans from there and from us, they are totally put together. That may not be sufficient for you to service the loan, but this customer somehow, okay, he has taken from commercial bank. Now he's finding it difficult. He go and takes a loan from Sampath. Can't do. He runs to Bank of Ceylon and takes a loan, rolls it over. When there's a problem, if this loan is settled from the another loan, something like that. Now people can roll. So that is the reason we look at it. But if you are really sure about the customer, you can, you know, go in without salary remittance also you can do, but you must know the risks behind this. Risk is this. Risk is this. I mean, they also can roll it. So my advice is that if someone is working in a particular company, they have a long history with the company, a stable employee, and while interviewing the customer, you understand that he is a good enough customer, he will service the loan. That's what I say. This is an art. When you're talking, you will know. And so there are some companies you will see even IT companies. For example, let me tell you this one. The Virtusa-like companies. Say you are giving say the IT professionals are there. You are giving a personal loan to them, and the salary doesn't come to your bank. There is always a risk for various reasons. I'm just taking Virtusa, not for the this one. I mean, any IT company, let us say. IT companies where the turnover is high. Employees will be working for 1 year here, another year there, then again they can come back to this company, go elsewhere, because the IT professionals are very, turnover is very high. So people can take loans, and then they will, they become unemployed sometimes, they become half employed sometimes, that kind of things are there, volatility is there. So you have to be careful in that, while, without salary being remitted, giving, whether it is okay. So what is any other fallback situation whether you have, because you can't rely on the employer. Many times employer cannot take the responsibility. They cannot take the responsibility to this. And even sometimes I come across a situation where our own employee, without telling these things, go and take a loan from some other bank, and then some other bank recovery people, when they call and ask whether this person is working in the bank, then I ask them, how did you assess your lending? I mean, if you're assessing and then lending to a bank employee, you should know that that bank gives a whole lot of stack of facilities to the employees, and above that, if a bank employee is going and borrowing elsewhere, that means they are overspending. So that risk they are taking, then they will face with a non-repayment. So that's what I mean. This is a kind of a, on the knife edge you are walking, because due to competition you will have to give without getting the remittance. But while doing that, you must do enough of background search to ensure that this you are assured that the loan will be paid without a problem. That's the issue, right? I can't give you a straightforward answer. Yeah, no problem, you can do that, and I can't say that. But due to competition, we will have to do. But a bit beyond, you must go and do your own research to convince yourself that yes, this loan will be, we have sufficient ways of recovering this particular loan, even if it is defaulted, kind of a thing. Are you okay?
Yes, sir.
Okay, thanks. Any other questions?
Yes, but there's another risk that if the borrower applied for the same amount loan in two different banks at the same time, it will not reflect in credit report now.
Correct. That's a risk.
Yeah, one customer came and obtained a professional loan of a loan of I think 3 million. Its repayment is around 60% of his monthly salary.
Okay.
After obtaining his loan, after I think 5 or 6 days, he came back to branch for establish a standing order to some other banks. I asked the reason for why this amount money. At the time, he revealed that he obtained the same amount loan in other bank. So
Exactly.
his monthly commitment is more than his salary.
Yeah. This is what we also exactly was discussing. This is the problem. This is the problem now. Even though we call them professionals, unfortunately, many of the people are in the habit of overspending. They are overspending. Now, this is a very good example. Now, what happens is that that guy is getting a standing order from here and then servicing that loan. Now, there will be a point where he will become, it will become very difficult for him to service this loan. At that point, he will go to another bank and take a loan and then try to service it. This is how they will roll it. They will roll it and they will go and get stuck somewhere. This is like a pyramid scheme. You know the pyramid scheme where you go and somewhere it will get stuck and then the people who have invested last will lose the money, right? So 3 giving to 3, 3 giving to 3, like that the pyramid scheme will go down the line. The scheme will stop somewhere. There the people last invested will all lose their money. So this is also like that. Now here the customer will go on a circus like this. So they have borrowed from you, they have borrowed from another bank. Now that by the time the crib reflects this, it's too late, because so he actually is a seasoned kind of a, I won't say fraudster, but maneuverer. He has found a way of tricking the banks. So he knows this will not appear in the crib when you are checking the crib, when he simultaneously applies. So he has taken the best of both worlds. He has taken, and then I mean he can service this one from that end, that one from this, and then he can keep on going on like this until at a point he is unable to do that. Then he will go to a third bank and then borrow. So this is what they will do. So that's what I say. It's a little fine line. It's a little difficult task. Just with the face value, we can't do that. So I have come across like these IT companies, many of the companies also I have come across, people have taken the loan and gone out of job. They've gone out of job. Now we were banking on the particular company's reputation, and then the lending officers were lending. But when they go out of the job, it's a problem. In this case, of course, when this guy gets stuck, it's a problem. Now, the job also is a risk. Under COVID situation, you know how many people have gone jobless, so half paid this one. There are many people who are paid only half. Or the people who are laid over. Like, I mean, when it comes to country like Sri Lanka, there is no other safety net like, government paying a dole monthly or something like that. I mean, that can't be done. We don't have that kind of a, we are not that kind of a rich country to do that. So high risk. So that's why I would say it's better to get the salary and then pay. If the salary you can't pay, means the person's background checking is very important. I cannot give you a straightforward answer to this. So you need to, be sure about your customer. But always we running behind target also, these are the problems. We have high targets, we have to run behind, we have to achieve. And if you are giving 3 million, you are very happy, personal loan, I'm giving 3 million. And, it's a substantial amount, but the risk is there.
But we have already salary undertaking remittance with us, but the other bank doesn't.
Okay. See. This is the issue. This is the problem now. Like I also find in the market, banks are operating in a kind of a desperate thing. Now, okay, we have with a personal loans or with a corporate loans, what I see is that people are very desperate, so they undercut other banks. Now, even now in corporate lending, I see even when the corporate big corporates, when you are lending at 5%, there are enough of banks which are running behind those corporates saying, are you getting at 5%? Come, I will give you at 4%. Something like that. I mean, even below their cost of fund also, the banks are running behind to go and lend it. Just, I mean, want to get rid of the liquidity, that's okay. But long term, bad effects are there. Long term, this will affect the entire industry. That is something that is a thought I would like to leave to you. Because when we are operating with 30 commercial banks in the market and then another 43 finance companies, yes, the competition's the ill effects of that is this. So that bank which is giving this 3 million has not looked at many a time when they find that, I mean, where some good bank, if the customer says that some good bank in the market, private bank or whether it is state bank or some good bank, they are banking with them for such a long time, and then when they show the statements without any credit evaluation, nothing, they are willing to give that. They will just give. They will just give the loan, thinking that they are a good customer. Because of that only that bank A is giving. That bank A evaluates the customer properly. That's why they are good customers of that bank. For them, we will close our eyes and give. So we will give, and even undercutting the rates and all that. But the downside is this, like what you say. Now this customer, you need to very carefully follow up. Very carefully you have to follow up, because he had the audacity just after getting the loan, coming and giving you a standing order to the other loan, and he had the audacity to tell you. That means you openly does that. You openly does that, giving less regard to his repayment capacity and the need to be prudent in financial management, and the volatility of the job and salaries and all that. He has the audacity to do that. So he must be a overspender. He is spending beyond his capacity. So that always is the recipe for trouble in future. So I can't give an answer to here to this is how you handle and all that, because that is the credit appetite of individual banks. That's what we were talking about. That's the appetite. So when your appetite is a bit risky, it can land the banks and the customers into a kind of a difficult situation. If they had probed the customer, where and where have you applied loan, where and where you have taken the loan, how much is the repayment, nothing, how much he has to pay. If they had probed more before taking the loan, customer would have come out with that. At that time, they would have stopped it. But they haven't done that because they have to achieve the target. That's the problem. Okay. Is it okay?
Yes, sir.
Yeah, I'm sorry that I'm not able to give you a thing like, I mean, you're okay, in that case you do this, like, I mean, I can't prescribe, because that is the inefficiency of our financial system that is being exploited by the customers.
For unsecured loans, it's better to call status report is better.
Yeah, you can ask for a status report. Sometimes what happens is that if you know that this customer is banking with such a bank also, sometimes these are unofficial. Sometimes, I mean, I can't say officially, I can't tell you, but unofficially it's like we check also somebody. I mean, that's good for the banks, like in the sense somebody looking for like, I mean, how we see something like that also. Yeah, status report, whether by verbally or whether it is by way of writing, that's better to find out. Because the financial system in the country has to take the blame also. Spoiling the customers. We spoil the customer with too many products. We are always, when to lend. We spoil the customer, and later it bites us. Right. Then we were talking about, the history of the customer, is past overdues, past reschedulements, what and what facilities are written off with the other banks. We look at from the crib, these are available. Legal action taken in where relationship terminated. Last time, we saw a case of old habits die hard, where a father borrowed in 80s and he didn't pay, and then it went to courts, and due to the security inefficiency of the bank, the securities were not kept by the bank properly, that the bank lost in the courts, and then the son, same party's son, coming to me and trying to establish a line of facilities, where my regional manager alerting me of the father's habits, and then me not lending to him. And then later this customer put another bank's DGM, actually DGM recovery was put behind bars. He was taken to jail for no fault of him, because he actually was trying to reschedule a existing facility land. It was given to this particular customer, and he structured a loan to recover that, and he helped the business to exporting of vegetable, tea, and all that. He helped that business from the outflow, from the inflow from that business, export proceeds. He was trying to service the loan, and he was trying to, on one side, turning the non-performing advances into performing, on the other side helping a customer to come up in their business. All that he did. Ultimately what happened, because of these customers' behavior is bad, they have a history from their father, that exploiting the banks, and then not paying off the banks, and then taking defaulting. That son also did the same thing, and this particular DGM of that bank had to go behind bars. He was arrested and put behind bars, maybe for a couple of months. He found it very difficult to come out of it. So his career is damaged, his life put in jeopardy. All that happened because of this kind of customers. So customers kind of a behavior is very, very important. That's what old habits die hard, I told you. Another example I told you was me as a country head for Bangladesh, when I was running country operations of Bangladesh operations of the bank. We actually kept a very senior person in the banking industry as our advisor, always, to know about the customer. Even though customers are very high corporates, huge corporates, basically the corporates in that market, you will find the MD or the owner of the company will not even get onto the road. They will go by the helicopter. You will not believe this if I tell you, but that is a fact. There are many companies which are having their own helicopters. They, from the morning, they will go to the factory by the helicopter. From there, they will go to the office by the helicopter. From office to home also, they will come by helicopter. That kind of, there are crazy customers like that. They say road traffic is more, we can't spend time on that. So that kind of a thing is there in that country. So even with that kind of a clout, and they are about 15% of the country is very rich. They are like, that huge, big customers are there. So these, amongst them also, to identify the people to whom we can lend, to whom we cannot lend, we always go back to their history and to identify. And believe me or not, till the time I completed my term as the country manager and came back to Sri Lanka, our non-performing advances was zero. We didn't have any non-performing advances. So that's very important. That's looking at the behavior of the customer. So just now you asked the question also, that applies here also. Ensure the advance use for a purpose. Now somebody who is asking up a 3 million facility for a let us say to do enhancement to it. With 3 million you can build a house also. Now if the land is there, with 3 million is enough for you to, I don't know, small oils or do some additions to the house, something like that, or whether for to purchase a vehicle they're asking for a thing more like that. Now, if you find that somebody is taking a double of that another amount of the same amount elsewhere and then using for that purpose, huge amount of problem. In many of the bigger companies, we have problems where the money is siphoned off to other companies. Now, in a group of companies, the holding company or parent company will give a guarantee and take a loan to a subsidiary. The subsidiary which is doing very well, their cash flows are very good. So they may take a loan. The subsidiary money will be siphoned off to another suffering company. That company invested, but no return. The project is not doing well. Now this company in the group, they will siphon off that money into that. So while investigating into the problems of Golden Key and while investigating into the Selinco group of companies, this kind of issues were there. Like intercompany funds being transferred from one company to another company, another company to another company, where the bank also involved as a subsidiary, Ceylon Bank also. So that's why Ceylon Bank came to the verge of kind of big problem where central bank had to take over and then run the bank and stabilize that and work on the non-performing advances, and then now it is managed. So these issues are there where we need to be careful about that while assessing individual with multiple businesses. Even as an individual, if you say, even if you have a sole proprietorship business or partnership business, these guys will have other arms. They will have one arm doing tea business, another arm doing let's say rubber, another arm doing consumer other food items. Kind of there may be various arms. So we will have to be very careful that what is the loan you are giving that is used for the purpose for which it is borrowed or intended. That post disbursement follow-up is very important. Where they are going and putting. So people having multiple business, always a risk that money will be siphoned off to some other business, right? Some other business. Some of the entrepreneurs, they always are very confident. They're very confident. When they first get the idea, then only they look at cash flow, currently working capital they have, they will go and put into that. And after that, they will come to your bank and then say that there is a business like that we have invested and we want to create working capital for that. Now, the business viability, whether the business can be run, can you do that business? Can you continue that way? That has to be assessed separately, that business viability. That the entrepreneur doesn't do. They go and decide on to invest, and then they will come and tell bank for their safeguard. I had a example. This is at a small level in a branch when I was starting as a branch manager. When I was starting in that area, there was a guy who was the agent for Shell gas. He was the agent for Shell gas. Now you know that in those days we had this Shell gas. The price is high. Actually, comparatively, Shell gas cylinders, the prices are high. Shell gas, it has its own cylinders, like any other gas company. They have their own cylinders. Now this fellow actually was a Shell gas agent, and then he actually was doing a good business at it, and then he was a good agent, and then he was looking after many areas there. Not only the area where my branch is there, where he was operating, surrounding many area agency also was given to him because he is a very intelligent businessman. But what happened is, another gas, competitor came to the market. I don't want to tell the name. Another competitor came to the market. Now, what these guys did was, that competitor's price of gas, a cylinder gas, competitor's price was, that's about 150 rupees lower than him, lower than shell gas. Then you think about that, about say 20 years back, what maybe the 500 rupee was worth much more than this. Now, if this shell gas is 500 rupee, these guys are like, 350 to 400, 350, like, they are giving that. Now, what this man did, my brilliant customer, he went to that gas company, took their this one agency without telling shell gas, and then he went and started filling up shell gas cylinders with the gas of that one. So he filled up anyway, in a way that company also, because they are coming up, new company, they also in a way they connived, looks like. So this fellow was filling up that gas with into this cylinder and selling, and then making a killing. So somehow this cannot go too far. The shell gas company got to know, and then they found out that their sales are less. Cylinder stock is here, turnover is not has come down, and this fellow is up to mischief, and then they got to know something wrong happening here. They, without his knowledge, immediately they claimed on the guarantee facility what he had. They asked the guarantee for the shell gas what he had. He had taken a guarantee facility and given to shell gas. They claimed on that. Immediately they claimed on that. So the bank had to pay the thing, and then they stopped the supply. So they claimed on that and then stopped the supply, and then he was out of business now. He's into trouble, all the facilities could not serve. So here it's a classic case how the customer's operation can really put him into trouble. Very recently, when I met the other gas company, the competitor gas company, which came new to their CEO, and then they are big now, CEO and their chief operating officer and all, they remembered that. They told that, if we were doing that, I said, I know that I was the branch manager at that time. So that kind of operation by the customer, which I came to know later, and I also stopped his facilities and all that. Somehow we had to go for recovery action and then sell his even residential property and all that. Those are things down the line which happen. Now the customers are in the habit of doing that. They will get into any business, some other business, and then without telling. Now he has got into a competitor thing against a contract with their main party, and he found that he can make a quick buck out of that. Like that, people do a lot of things. So ensuring usage of the advance which is given and to a particular purpose is very important as far as you are concerned as a lending officer. That's what I say. Like, these kind of group companies, these kind of customers who have multiple lines of business are a risk always to the lending officer in ensuring that they are using the working capital you have ordered, loans, what they have, facilities what you have given, used for the purpose intended. Right? So with that, we shall take a break. We will meet up by 10:55. Yes. Okay. All right. We'll take a break. So we looked at people having multiple interests, and then the need for the lending officers to be very careful about this particular thing, because that's a very weak area where customers can move funds from cash cow, that means revenue generating, good revenue generating business, to that kind of business which is kind of spilling, in the sense, I mean, which is not doing well, which is actually bringing down the profitability, which is actually weakening the whole process. It can happen. Now, there are also many CEOs, many the owners of businesses, they have their own pet projects. Pet projects in the sense, I mean, they want to do something which commercially doesn't make sense, but for their own ego they will do. I know a group company where the other companies were doing well, but then the CEO was going and investing a lot, and then actually working on a particular dairy farm, which, of course, for a long time, which was not really, coming up well. But still, for all, it was the CEO's, the main investors' project. So that happens. Now, in many of the, even in financial institutions, this happens. And in many other companies, this happens where they run behind certain projects which are for ego purposes. I want to do this somehow, which can bleed the other businesses, which can bleed the group, and which can affect the other businesses. So lending officers need to be careful about that also, wherever possible, to advise the company on that, and then discontinue certain operations and all that. That part also, advisory role also has to be played by the lending officer. And the other important thing is that there are enough of people who put their name and try to get the the borrowing objectives achieved. Name lending. Name lending is one of the very dangerous areas, because we will have to give, for example, let us say in the country, big names like, John Kills Holdings, they're asking for a facility, we will work immediately. I mean, Haley's, they're asking for a facility, we will do and work. I mean, it can spend a group company asking for a facility, which we will do that. And there are a number of, people who are also individuals also, their name, when it is dropped, which carries a high, acceptability in the market. But that's a double-edged sword also. It can cut you, because few of those guys are in the habit of rolling. They will borrow from you and go to another place, and they are also, because because of the acceptability, it's easy for them to raise funds. They raise and try to service. Sometimes many of those facilities also go bad. And when you ask also, it's so difficult. I mean, they are very diplomatic in handling those things. And then they say, I mean, your money has been invested here. He's currently not doing well. So we will see see ways and means of paying that. Especially in pet projects, like what I told you, people take and put there. That doesn't really give the return. And these guys will not divert the cash flow from other businesses. And then they will say, we will do something, and then settle in. They will drag on. They know they have the clout to drag on. Talk to the CEOs also of the bank and financial institutions, and then keep on dragging on. So we need to be very careful about this name lending, right? Going by the name lending, there should be substance. That's why the original principles of credit is very important for us to look at that. At least to some extent, we must see that and then ensure, even while doing the name lending. Otherwise, if you go and see that reputed company, reputed names, under that, whether they are non-performing, mostly this is the case, where without really looking at the purpose, without really looking at cash flows, future feasibility of the project, because somebody wanted, given. A lot of names are there like that, right? So the basic lesson for lending officers is that avoid name lending, lending on perceived reputation. Many of the people outside look, and then inside when you go and see are quite different. It's quite different. Outside, they always spend on keeping their kind of a reputation in their brand and all that. Inside, when you go and see, a whole lot of problems. They have a whole lot of problems in their own affairs, in their companies. Lots of things like these. The management is maneuvered. Management was asked to do something, but they won't. If they put a professional accountant, CIMA qualified, ACCA qualified accountant, they will say, no, we have professional ethics. We'll have to go by the professional ethics and then only do then all that. Then they will be fired. Or that such professional himself will leave the organization and go. He will say, no, I can't work under such a unprofessional way. I can't work, and he will leave and go. There are enough of companies like that. There are enough of names like that in the market. So that's a word of caution that we will have to be careful about in name lending. So while doing the credit appraisal, I mean, we should not rely on the collateral much. Collateral is that's what I keep on repeating. It's just a fallback situation. You only will rely on the fallback, like something beyond the control of the customer. Something happens, what to do, how to safeguard the bank, financial institution. This is what will be done. But when it comes to what happens when it comes to thanks. Sorry about the interruption. Now, when it comes to companies, you need to rely on the purpose for which it is given, their repayment capacity. That's what we had been repeating. So, should not over rely on collateral. Should not over rely on covenants and conditions and covenants. You mean to say, for example, what do you mean by covenant? Let me tell you this example. Let me tell you, now IFC is giving a loan to your bank. Your bank is getting a, let's say, $50 million loan from IFC. Then IFC tells you that this should be lent to SME. So you are taking a loan from IFC, $50 million, and then you will convert into rupees and then do lending to the SME sector. And then they will have some conditions. These are the sectors you will lend, these are the sectors you will not lend. They will say any illegal activities, any contract farming for tobacco and all, you should not lend. That's a covenant. They will say if you identified lending to these areas, there will be a penalty. Right? That's what I mean. After dispersing, these are covenants which you need to adhere to. So a covenant is a promise by a party to a contract, that is, let us say your bank, to do something or not to do something. So to do something means lend it to proper legal sectors, not to lend it to prohibited sectors, illegal sectors. You don't do, right? If the promise is broken, the breaching party is liable to the other party for monetary damages. Let us say whether your bank will be liable to the IFC for monetary damages. You have done this, so that you will have to pay a penalty for this and then stop the lending from that. So that kind of a thing, that's a covenant. Now you will say you have you have put a you have given a loan to put up a factory, right? So you will say the factory, the money will be dispersed to put up a factory, and then there can be a covenant that the diffuse, the wastage going from the factory, you should have a water treatment plant. So you don't go and release the dyed chemical waters to the national water streams, to the river or to the water line or whatever. You don't do that. So you need to have a treatment plant. Water treatment plant, this chemical diffuse the wastage water which is going, you must treat it and leave the clean water to the water streams, whether you are releasing to the other water streams or river or whatever. That can be covenant, right? That can be covenant. Now, if the customer puts up the factory, business is running, and then you go, you do a inspection and see, customer has not put the water treatment plant. He is just releasing the chemical to the lake or river or whatever. then it's completely, environmental issue. It's violation. Bank also will be found fault with. So that's a break of a covenant that will call for immediate rectification and then penalty for that. So that's a covenant. Then condition is like, at the time of, there should be something which should be done by the time of you establishing the facility. Let us say that, when we give this loan, environmental authority or approval should be taken. That's a condition, right? Have the company taken the environmental authority approval to put up a factory or commercial venture in that area? So if that approval is a condition that should exist at the time of releasing the loan. So that's a condition. That's the difference between a condition and the covenant. You must know, right? Any question on the condition covenant what I spoke to? Any question? Whether you understood or not? What kind of things we talk about condition? What kind of things we talk about covenant? Are you okay? Yes, children, please speak, somebody.
Okay, sir.
Okay, thank you. I think I will have to announce next time. If somebody speaks, I will give you 100 rupees. Right? Somebody shares, discusses, I will give you 100 rupees. Every time you speak to me, every time you discuss with me. So that week it can be interesting. Right? Okay. Right. So your own institution will have your own risk rating system, different ways of rating risks, right? So your institution will take decisions based on the risk rating assigned to a particular customer, right? For example, let us say a customer of very high standing, his repayment capacity is excellent, is a top, like, rating like A1. Like that, based on the deterioration of the quality, like, it can go on till about A9 something. A1, A2, A3, A4, A5, A6. A6 about to transfer to non-performing advances. A7, non-performing. A8, like bad, right? A9, unrecoverable type of, like, different, it's not the uniform thing, but different financial institutions will have different ways of, like 1, 2, 3, A1, A2, A3, or different ways of assessing the risk of a customer and assigning a rate. And that assigned risk rate will give comfort to the financial institution to sort of decide on what type of a facility to be given, what is the amount of facility, like any enhancement, whether we can go excess on this, how frequently we must review. Let us say this is a risky customer. We should make a quarterly or half-yearly review. Other customers, okay, annual review is enough, something like that. And the interest rate will be decided on that. There can be like, okay, your bank or financial institution can have something like, okay, A5 customers, beyond this, we will not take beyond this amount. There can be a threshold, right? So have we come to 50 billion lent to this sector, we will not take on any more customers. These are risky sectors, right? Something like that. So financial institutions will have their own risk rating system. So that actually decides whether we can go without, certain, clean basis when you are lending. Say even if you take stocks and book debts and all that, those are clean basis only. When you are lending to the customer, they must only for this rated customers we can give. Below this rating, we will not. We will ask for a good security, some other cash cover we will ask for, something like that. And then interest rates also. We also will look at kind of RAROC model, we will say. Subsequently, we will say. Then interest rate will be based on the risk level of the customer. The more the risk, it's a risk versus return. If the higher the risk, higher the return, right? You increase the interest rate if the risk is high. So in a way, you are trying to compensate for the risk you have taken. You are trying to compensate with a higher rate, risk versus return. Review of risk rate at least annually, it has to be done, right? At least annually. Normally, all the financial institutions will look at reviewing because the risk levels of the customer will keep on changing. Now, a company which was doing perfectly well up to February 2020, now they may be in dire straits because of COVID-related closure, COVID-related business going down. So review of risk rating at least annually is very important. Risky customer beyond a particular risk rate has to be reviewed, say after 3 months or 6 months or based on the risk level. So if let us say somebody who was A3 customers might become A5 after these issues, if they are affected by the COVID, kind of, the risk levels have deteriorated, profile has deteriorated, not because of their own inefficiency, but because of the market in the country situation. So as the risk levels deteriorate, the rating will be downgraded. So it will come, A1 can become A3, A2, A3. So A3 can become A4, A5, right? So A5 can become A7, something like that. Or the different ways in which it is assessed will downgrade it to the next door, the lower levels. For a lending officer, for a financial institution, for a bank, this is a make or break thing. Pricing your assets. You need to learn a lot about pricing. Why pricing is important, how pricing is playing a dominant role, what are the factors which is going into deciding the pricing of products, right? It is very important. There are so many things are there in deciding the pricing. So the Basel requires, Basel 1, 2, 3, they require that, you price your assets based on your risk profile, based on the customer's risk profile. That's the Basel requirement. So purely if you have to go by the Basel requirement, yes. Then there are other requirement also which is there, which may not allow us to 100% go with the Basel requirement, because if the government says that housing market you must only lend at 7%, which is not in line with the Basel, right? Which is directed lending. But for us, central bank regulation is the supreme thing which we'll have to do. So we'll have to have a balance of these. So pricing, yeah, these also come into being, like there are things which are beyond our control. Now central banks, they directed lending is something which is beyond our control, which is central bank will direct based on the direction received from the Ministry of Finance and then and the government, right? For various other reasons, government would like to, for good reasons, they would like to keep the rates at a lower level. So that also will have to be taken into account. Now, under normal circumstances, if we price inaccurately, how it can affect the financial institution? The financial institution will be affected by the imbalances, right? Where the pricing is not properly done. Either priced it high or priced it low. Like that can create an imbalance in the asset portfolio in the returns, and then the opportunity is lost. Where if you had done properly, your return would have been higher. and go into adverse loan selection. Sometimes looking at showing like high return loans, we may get into risky sectors, which may not be basically the appetite of the institution, right? And profitability goals and objective also will have a say on the pricing, because before end of the year, we need to achieve this kind of a profitability target. For that, these products, if it is done at this particular rate, only the profitability can be achieved. That also will drive the pricing objective, pricing decisions. So lending officers should, like what I told you, risk-based pricing we need to understand. Risk-based pricing, like what I told you, the higher the risk, higher the rate. How do you sort of take all this into account and then have that also factored in is what is important for a lending officer. So your pricing, basically, you need to align the pricing to the expected credit risk probability of default. That is after the under the Basel III and these IFRS 9, which briefly we will look at later. IFRS 9 is the accounting standard, or Sri Lanka SLFRS we call it, financial reporting standards. Under that, of course, we are deviating from a historic based impairment to future cash flow based. So it sort of goes to, even from the first installment, you may have to make impairment provision, right, based on the probability of default. So probability of default is that what is the probability the customer may default. That kind of a assessment has come into being with this IFRS 9 accounting standard. So this is the future. Under new standards, our published accounts has to be based on that. Now, Sri Lankan banks have kind of preparing 3 different set of accounts. One set of account is based on these, and for published accounts will have to be under the requirements of IFRS 9. It has to be reported. Then central bank will have historic basis according to their approval. It has to be done. For central banks, separate different set of accounts. For publishing, different set of accounts. And for taxes, different set of accounts. Income tax department, how we pay the income tax is according to their regulation. You will have to do the accounts. So the profitability which is shown for tax purposes is different from the profitability shown for the purpose of shareholders in the accounts. That may be different from the profitability shown for the central bank in doing the central bank based provisions. So these are things who is working in the accounts department will understand. We don't need to go deep into that, but for you to, this I'm telling you for your information. That is a Herculean task your finance and accounts department will have. Your CFOs will have. They need to have different sets of accounts, different ways of preparation, in satisfaction of different stakeholders. Central bank, you need to satisfy. Inland revenue, you will have to satisfy and pay the taxes. Otherwise, they can charge a penalty. And then your shareholders, you will have to publish the accounts as per the IFRS standards. So that's a very enviable task what the central, finance and accounts will have, your CFOs will have. So align the pricing, loan pricing to the expected credit probability of default is important, in your pricing decision. And pricing also depends on the credit risk profile of the customer, which we looked at, the tenor, right? The longer tenor, maybe pricing will be higher. Under current situation, liquidity is very high in the market. So short term, customers will ask for lower rates. But in the long term, the liquidity position can change in the market, so that banks will charge a higher rate for long term, right? So it depends on, sometimes the short term becomes more costlier when the liquidity is low or there is liquidity problem in the market. Banks will have to borrow at a higher rate and then do the lending. At that point, short term price will be higher, but long term price they will give lower, thinking that, I mean, long term this liquidity problem will not be there. So it can work both ways. Under current situation, short term loans are low. So long term higher compared to short term loans. That is because of the very high liquidity the market has right at the moment. Right. Then cost of funds. This is another important factor you must keep in mind. Every bank, every financial institution has a different cost of fund. A bank, a bigger bank like State Bank or People's Bank, Bank of Ceylon, or bigger banks like Commercial Bank, HNB, and all will have a better cost of fund. Simply because of the high amount of CASA accounts, current account, savings account balances, high balances are there. Due to that, their cost of fund is low. If you compare commercial banks with that of finance companies, many finance companies, they can't have current accounts, right? They can't have current accounts and operate. So when they don't have, their cost of fund will be higher. They will, some of the finance companies are allowed, or many of the finance companies are allowed to attract customer deposits by way of short-term loans, short-term deposits. So their cost of fund, they will have to give a higher rate than the banks to attract deposits. So their cost of fund will be higher. So due to that, finance companies their loans will be higher. The lease rates will be higher, because they can't afford to give at a lower rate like the banks because of the fund base. They also borrow from the banking industry. They borrow from the commercial banks, right, for their lending purposes. So due to that, their cost of fund will be higher. The banks like Bank of Ceylon, People's Bank, will have high amount of deposits with them. Even People's Bank, Bank of Ceylon will have all the government departments depositing with them. Due to that, the government funds are also kept there. So that gives a better cost of fund to them. The cost of fund will come down with that. So they will be in a position to do lending, even though they have other problems of managing with the direct lending. They can operate with a lower cost of fund. Like that, the private commercial banks, Commercial Bank, the HNB, Sampath Bank, and all will have a larger amount of savings, current accounts, and deposits, which will give them the comfort to lend at a lower rate comparing with their cost of fund. So the cost of fund is a very important factor in pricing a loan. And liquidity of the bank is another important criteria. The banks, different financial institutions will have different levels of liquidity. That is like, the amount of deposit you have taken, the amount of capital what you have, right? How much of capital you have, how much of deposits you have taken. Out of that, how much have gone into your other assets, and then your lending and your loans. Then the difference what you have. So your deposits, of course, basically with your deposits, you would have borrowed from the market also, short term, long term, and borrowing also will be there from various people also for your bank. That is your liability. Then the advances and your other assets, what you have, your land and building and everything, where you have invested everything. When you deduct, there will be a balance. That is your free float, right? That is your free float for your treasury. That amount only the bank has the free float which they can lend in the market, right? After satisfying the regulatory requirements of reserve requirement, liquidity, statutory liquidity requirements, statutory reserve ratio, after all that, they will have the balance which lendable amount. That lendable amount is what your treasury will keep in the short-term money market accounts, and that is the amount which will be the liquidity for running of the. So the liquidity high means they can afford to give it a lower rate, short term. So they will know that, I mean, this liquidity, how long, what is the liquidity bucket. We looked at the ALCO functions. The ALCO will see that, I mean, what is the maturity of my assets, how much I have to pay out from my assets, from my loans, how much I will have to pay out loan, how much I will be recovering during the next 3 months, 6 months, 1 year, 2 year, like how much I will recover. And from my deposits, how much I will have to pay out, how much of fixed deposits are maturing, 3 months fixed deposit, 6 months fixed deposit, 1 year fixed deposits. What is the pattern of my savings accounts which will be withdrawn? So my pattern of savings account is that from my savings portfolio, I have a, say for example, I have a 400 billion portfolio. I have out of that about 20% I must keep ready for, you know, people withdrawing and all that. Like, I mean, that kind of a calculation the treasury will have. So then they will have the liquidity. That liquidity only used for doing the lending, and based on that only the pricing will be also has to be decided. So that is one of the important factors. Liquidity of your bank or your financial institution also is a very important criteria in doing the pricing. Right. Now we have looked at so much of areas in pricing. This is one of the important areas for you to keep in mind. Say Basel-based, risk-based pricing, that factor, right? Your profitability objective. But most importantly, when you're looking at, these are the important things, when you're looking at customer risk profile, what is the tenor you are looking at, what is the cost of fund, what is the liquidity of the bank, right? And then you come to these areas also, risk-based pricing, and what is the profitability goals. All that is important. So these factors, please note it down and keep it, which is very important for you. So pricing, like what I was telling you, probability of default, which is the IFRS 9 requirement, where you look at not the we were calculating our provision requirements or central bank's loan loss provisions and all. We used to do that using the past record. How much this is overdue? 3 months overdue, 60 days, 90 days, what to do? 120 days, what to do? 180 days, what to do? 360 days, what to do? 540 days, what to do? It was overdue. So based on that only we were making provisions. How do we do the haircut? All that we will look at later. All that is done. Now future is that currently under IFRS 9, you look at future cash flow. What is the cash flow of the customer? Whether you foresee that, I mean, customer will find it difficult to service his loans. You make a provision now itself, impairment provision now. That's what I'm talking about. Probability of default. That is the IFRS requirement, right? And based on that, based on the customer's probability of default, also the pricing has to be decided. That's what we were talking. So alternative. Now when you're assigning a alternatively, when you're assigning a risk rate to a customer, based on that risk rate also you can do the pricing. So for example, this is not the standard. I'm just giving you a guideline how the banks will decide. Now let us say customers risk rating is A1 to A3, like I told you. It can be, I mean, it depends on your bank's way of rating customer. If it is A1 to A3, the pricing to the customer will be okay at PLR or PLR. PLR is prime lending rate. We call it average weighted PLR also, where all the banks, now let us say every bank, central bank will take every bank's top customers, lowest rate given by that bank for 10 customers. They will by the amount which is given by the rate given, and they put all the banks together, like the identified for the benchmarking. They put together and then take a weighted average prime rate, which is called prime lending rate. So weighted average prime lending rate is a reflection of what is the lowest rate, average of the lowest rate given by the banks in the market to the top clients. So that's called PLR, right? Prime lending rate. So now your bank might decide, okay, if the customer rating 1 to 3, I will give him loans at PLR, right? Then next rating means I will charge 1% more than the PLR. Next rating means I will charge more than the PLR, 2.5% more. Like that, I will keep on increasing. So this is a structure which is approved by the credit committee of the bank, right? The credit committee can. So now let us say, like, I mean, substandard B7 and B9 and all that. I mean, let us say this kind of grading you have for default customers. So that will be decided on case-to-case basis. This can be a policy framework for a bank, for a financial institution, how to price my loans, right, based on the risk. Okay, within that only they will have other consideration in tweaking this particular rate. Anyone wants any explanation here? Have you understood? Are you all okay? How you all do the pricing based on your internal risk rating system? Right, this you can probe in. Yeah, go ahead.
Yes, we do. Two doubts I have is this external validation of this risk rating system, whether it can be done internally also, or we should go for external validation.
Yeah, external rating. Now, if you are a customer, the other way of rating is that your corporate customers are asked to give their rating. Now, if your corporate customers are rated, if you are given a risk rating thing, let us say you are lending to John Keel's Holdings, and then they have given a rating report. Currently, it is applicable. Let us say it's a AAA rating given. Right, so AAA rating given means okay, you can look at AAA rated means on what grade you will look at. AAA rated customer, they will come under the A1 A3 category, right? They will come under the A1 A3 category, and based on that also you can say that. That's why in this that can be factored into this particular rating system. Now, top rated customer, now based on that they can be put into a structure like this. Bank will consider these both in sort of clubbing the customer which category the customer belongs to, so that external rating can be taken as a guideline for them to put them into the particular different risk rating in the bank, the financial institution. Okay.
Okay.
Right. So ideally speaking, but no, doesn't always happen. Ideally speaking, your price, what the price of your advance, how you price your loan must compensate the bank for the marginal cost of fund. So we looked at the marginal cost of fund. But so if you are giving 100 million facility, to get that 100 million, from the last deposits, how much is my cost to get the last 100 million, something like that. You look at the marginal cost of fund to get that, and then based on that, it should compensate. That's the basic thing. The indicator. It is not always you can adhere to, but that's a basic indicator where ideally the price of the advance, because in total, taking the entire liability portfolio into account, your cost of fund may be low, but you are borrowing in the market, from your new products, your cost may be high, right? When you are lending, ideally, if your pricing is higher than your marginal cost of fund, that's ideal, but it may not be the case always. The other one is opportunity cost of fund. Opportunity cost of fund is that rather than going and doing a lending in this sector, if I lend in that sector, whether I will get a higher return. So whether it compensates, like, I mean, that kind of opportunity cost also we will look at and try to take the pricing decision. Now, if the government says that, I mean, you will have to lend only at 7% to housing, you have no other way. Even though you can't look at this thing, you will have to go and lend at 7% only. So those are factors. But under normal circumstances, when you are looking at, you look at your opportunity cost, you look at the sector which at a lower risk level or at the same risk level, a particular sector which is yielding high, you will look at it. So if that return is high or comparatively higher than what you are trying to jack up your pricing, right? Okay, I mean, the pricing has to be for this sector, has to be this, something like that, right? Then the cost of undertaking the transaction also involves, I mean, like, let's say you are going for a syndication loan. Syndication loan is many banks getting together and doing a facility. Why syndication loan is required is that, say somebody wants 5 billion facility for an investment to buy a company. So 5 billion, one bank cannot go and give 5 billion. Like, they have their own single borrower limits, their risk appetite and all that is there. So that one bank can, take the responsibility and raise the funds through the other banks also. This is syndication. Down the line, we will look at that also. This is syndication. Syndication is that one bank, that's called a lead arranger, arranging with other banks also to raise the 5 billion funds. So one bank can say, I will put, lead arranger will say, okay, I will put 1 billion. And let us say about 6-7 other banks will put in various levels. I can put 1 billion, I can put 800 million, I can put 500 million. Like that, I mean, you pool all that different banks and then give the loan to the customer. So one will be the lead arranger in getting that. So there are a lot of work involved in that. So the undertaking this transaction, there is cost involved. There is overheads. There is a additional work involved. Staff cost, stationery, all that is involved. So that also has to be compensated in pricing your loan, so that, I mean, your price of that particular loan can be higher than normally if you are giving a 1 billion loan to somebody, because that has higher workload to be done, right? Risk also is high, right? And then inherent risk of the borrower, and then probability of default of the potential default. Probability of potential default only we were talking about. What is the given the current cash flows of the customer, what is the potential of the customer defaulting the loan? That you right from the beginning itself, you look at it. That's the PD calculation, probability of default. Okay. Any questions? It was a little heavy. Do any term or anything what you feel like I should tell again? I should explain again. Tell me now. Anything you didn't understand? Anything I don't know. I'm not doing credit. I'm doing something else. So that, I mean, this particular thing I did not understand. Or like, I mean, if you want to say something. Yes. Hope you all are listening. You are not watching a Sunday movie and seeing this. Okay. Be expressive. Tell your views. Tell where to pause. Tell where to repeat. Tell where to discuss a few areas. I am not all that happy with your participation, which I always tell. You must participate. That's the actually beneficial to you, and mutually beneficial in a way. Like, I mean, I know to what level I am to pitch, to what level you will understand, right? Even if you have any, yeah, go ahead.
So in the syndication, whether lead bank has the right to fix for the pricing, or the all banks have a say?
Lead bank will indicate to the banks at this rate. Lead bank will decide and indicate. And if the participating banks have any concern, they can say that, no, at this rate we can't lend. Shall we consultative? The lead bank, they will get engaged, and they will say, shall we increase the pricing here? Because we can't, if we at the rate what you are indicating, it's not beneficial to us, so profitable to us. So give 0.5% more. The participating bank can always say. So if the participating bank, if the lead bank is not willing to that, participating bank can always say, no, we can't participate. They will go, some other bank who has the appetite will come. So always it's consultative. They consult and decide at what rate. The lead bank cannot, push on the participating bank. The participating bank has to be happy with the rate and the commission. There will be a commission also. Participating commission will be there. That will be shared amongst the banks. Yeah, any question? Okay. Okay, so we have elaborately looked at the pricing, right? So you are expected to be a master of pricing alone. Okay. End of the day, what matters is that lending officer should work towards maximizing capital utilization, right? You look at maximizing capital utilization. Yeah, your bank has a capital. That capital, lower the risk, it is better utilized. But if you go into higher risk sectors, it is compensated with more return, right? So that kind of a consideration. So lending officer should work towards maximizing the capital utilization, right? Okay. Okay, I will touch on this. Like what we were looking at in lending, let us say certain sectors have a lower risk weightage given by the Basel Committee and the central bank. For example, commercial loans given, they will say 100% risk weighted. In that case, they will say, okay, if you are given 100 million facility, then you must have capital of that 10 million capital you should have. That is fully risk weighted, right? 100 at 10%. If it is 10%, 10% risk the capital you should have. Like that, many sectors, they have given rates. SME, they say 75% risk weight. So it will be like, 100 million lent to SME, 75% risk weight means only on 75 million, you will look at 7.5 million, capital requirement. If it is residential housing, right? Okay, it is it is occupied by the borrower, right? Oriented 50% risk weight means you have given 100 million facility housing loan, and which satisfy this one. And that your capital cost will be, you will have to keep a capital of say 5 million, right? It's 50%, right? Is 50% of the risk weight. So you are going to calculate the 10%. I'm just talking about the 10% thing, but under Basel III, you have a capital overall amount of 12.5 for less than 500 billion capital companies. More than 500 billion companies, there's a 14.5 capital has to be there, which is the domestic systemically important banks we looked at, DSIBs. So DSIBs have to have 14.5%. So like that, this capital, total capital 14.5%. So like, if you take in that way, for residential purposes, if the loans are given, it is like, 50%. on the 50 million, 100 million loan given, on the 50 million only you will calculate the capital. Like, I mean, you are risk weighting. For example, if you are lend for gold, you are lending against gold, pawning facility. For that, you don't need to keep any capital because the risk weightage is 0. Right? Okay, so allocation of capital commensurate with the credit risk inherent in a personal. So based on that, you are adjusting the risk weight according to the prescribed risk weights of your lending. Whether it's a commercial loan, or whether it's a SME loan, or whether it's a gold lending, or whether residential loan, whether personal loan, all that. Based on that only capital is. So our idea is to maximize the capital usage, capital allocation. So higher the capital allocation, higher the risk. Based on that, you give high rate for facilities, for loans, which attracts high capital allocation. So in that sense, you are talking about a customer to whom you are giving a commercial loans. Let us say, according to central bank's regulation, 100% risk weighting is needed. Then you will have to charge him high. For residential purposes, you will charge him low. Right? For pawning facility, you will charge low because you don't have capital allocation. That's the risk-based pricing, risk-based lending. That may be the reason why central bank also started kind of regulating the pawning facility rates also. They know for a fact that you don't need to keep capital for the pawning facility, and then you are not going to be, the default rate is not going to be high there, because you will self-liquidating type of asset where you can auction the pawned item and recover the loan. So this is what we talk about risk-adjusted return on capital. So your usage of the capital. So this simply, financial institution cannot adopt. They need to have a model developed. That's the biggest task. They need to have a model developed. Based on the model only, they will have to do this. So because every lending officer cannot go and calculate, I mean, what is the capital allocation here? So how much is the price? So you need to develop a model so that, I mean, when you put the figures, when you put the sector and all that, that particular model should throw you out. This is the rate it should be. You must charge a rate. That part has to be, that's the IT work has to be done. Based on that only, on the RAROC model, pricing can be done, right? So for us, we explain this, but practically to calculate and do that all, a model should be developed. So this is what we were talking about: pawning 0, all others 100% risk weight, normal loans, higher risk weight than SME, housing, and all that. I mean, these are the factors which will go into RAROC model. Risk-adjusted return on capital. Keep that in mind. So what it indicates to you is that it's a platform to calculate the risk versus return. The higher the risk, the higher the return. Lower the risk, lower the return. Like that. So there's a uniformity in pricing decisions. When you apply this, there's a uniformity, right? Because based on the risk, you are charging the return. So there is no kind of a favoritism played, or like I mean, unduly somebody getting advantage. There is a uniformity in estimating the customer profitability to the bank. Emphasis on appropriate compensation based on risk considered and measured. So you have, I mean, you risk you consider and measure, and then based on that you are putting the customer into a particular risk bracket, risk rate bracket, and then based on that you are calculating, and there's a straightforward way you can answer this. And then you also can do what if calculations. In the sense, if the the customer is A3, if he becomes A5, what may be the rate? Right, a customer is A3. If he becomes a top-notch customer and then becomes A1, what may be the rate he will enjoy? So that kind of a what-if calculation, what if, and then especially the profitability from the customer. How the profitability from the customer will vary, because the customer profitability is one of the important criteria for acquiring, retaining, and discontinuing a customer. A bank will look at keep the customer with high profitability and continue, and customer who is not giving higher profitability will be treated in a lesser privileged way compared to the top-notch customers. So this one we'll discuss different pricing. You need to have different pricing for short-term lending and long-term lending. That is, those are the factors we looked at. Why? Because the liquidity matters, and the market can be very liquid now. Short-term liquidity is quite high, so that you will price low. But if the liquidity is very high, liquidity is very low, you will charge high, right? Because your borrowing cost is high in the market, right? And then many of your loans, the people who are doing corporate facilities or big size SMEs and then corporate facilities, you will know we have this PLR tagged rates, PLR plus 4, PLR plus 3. That's what we looked at here also. PLR plus, what you, based on the risk rate, what is the rate, minimum rate what you will quote. So this PLR rate, place rate as its advantage. Why? It's floating. Now, if the current PLR is, let us say, 5.66%, last week it was 5.66% PLR. So even if you lend at PLR, it is 5.66. If you look at 1%, 2%, 3%, 4% more than PLR for different loans, that is your return. Now, when the PLR increases, when the market liquidity is drying up, when the market liquidity is low, then the PLR will go up, because these are based on the market liquidity. So when it goes up, if you have fixed rates given to the customer, that's a risk to the financial institution, because that rate you can't change. You have agreed with the customer. You have given him an undertaking that time and this will be fixed for this period. Then it's a problem. Now PLR base means you do not have a problem. You are sure you're going to get the return. Let us say PLR shot up to 10%. Then you know that you will get a 14% return. Or 10% up to 14%, whatever rate in between you have fixed it, PLR plus something. So PLR is beneficial for the financial institutions, having PLR based rates, where the customer also gets the current rate always. So if the rate is low, he gets the low rate. If the rate is high, he gets the high rate, because PLR is a volatile figure, prime lending rate. So if you are working, in lending, if you are doing, bigger corporate, proposals, you will know for a fact that before going and committing a loan, let's say going and committing a loan of 1 billion, committing a, total facility of 2 billion, committing a loan of 500 million, it depends on your bank. Before doing that, you always will have to ensure that the liquidity is available and at the price rate you are going to quote. So always the lending officers, the relationship managers will have to check with the treasury department. Your treasury department, they will check and say that, okay, this loan, whether we can give it at this rate. The Treasury Department is the one who is handling the fund from the center. They will indicate. They will indicate, okay, anything above this rate would be fine. Like, so the liquidity and availability of fund is very important. You just can't say that, I mean, okay, I have a target of 5 billion. With one customer, I can achieve 2 billion. You go and give a letter of offer to the customer, or like, I mean, agree with the customer, 2 billion at this rate I can give. Then later, when you come back to the Treasury says that we don't have that much of fund. You should have informed us earlier, right? Otherwise, you'll have to borrow from the market. When you borrow from the market, it's not we can't lend at that rate, at the rate what you are quoted. It will be a problem, right? So that's the reason. Bigger facilities will have to be referred to the treasury of your bank. And the other important factor is the competitor rates, right? In pricing, we may think that according to the risk rating and then according to the customer's risk in this sector and all that taken into account, our liquidity position, everything we have looked at based on these, we say that, I mean, we need to charge the customer 9%, right? Say for 100 million loan, we are going to charge 9%. Then the customer says that competitor is willing to give it 7.5%. You have a problem, because we can't be out of the market also. If we just say no, 9% is what, I mean, our ROC model I have done, and then based on that, this one, all the other factors I have taken into account, and this is the rate I have to charge. So I can't bring down below 9%. But the customer genuinely says that there is a 7.5% proposal there, and we will have to find a way of meeting that up, right? So competitor rates also important consideration here. So along with that, that's what I say. Even though ideally we can go with the ROC model, sometimes the way the market is behaving, we may have to adjust ourselves. So negotiated fair, reasonable pricing, you know, considering all these is important for us to arrive at the pricing. So very elaborately we have covered the pricing, right? We must keep that in mind. This is a very important area for a lending officer, and in this course also, pricing is very important. What are the factors you are considering in pricing, and you understand, you are able to explain also, right? It's a core area of your subject. The other important area what I want to tell you on the lending is that oftentimes this is forgotten these days. Ethical practices is very important, right? There are circumstances under which your ethical practice you may compromise. You must be aware of that. Why? Because we are a financial intermediary. You all are part of this financial intermediary, and the sustainability of the bank, financial institution, depends on public confidence. If the public has confidence, you will survive. If the public doesn't have confidence and they suspect your operations, then you die, basically. So this has happened to many finance companies, banks also. So instilling confidence in the minds of the customer is very important. For that, you must be fair in your dealing, right? So things what you do, if you like, you know, type of, say for example, you have your friend, you have your close relative. For them, you want to give a very favorable treatment. You want to give a very low rate. For the same type of customer, you are giving a high rate normally. For this one, you are doing. And the customer actually cannot take that much of a loan because his repayment capacity is not sufficient. But still you do tweak, and then you do some you know, maneuvers, and then convince, and then you put a proposal and you get it approved. So you are being unethical. And this unethical practice, when the it can put the institution into danger. Maybe it may be your friend, it may be your close relative, whoever. When you are trying to do that, it's a problem. When that kind of a loans, it may be 100,000 personal loan, it may be a 100 million commercial loan, it may be a 5 billion worth of total facilities for a company or whatever. Wherever it is ethical practice. If it is not there, it is actually bad for the institution as well as the industry, right? Which time to time happens. Unethical practices are carried out by lending officers or higher ups, people in the corporate management, people at the CEO level, which are coming out and which really puts the institution into danger, right? So ethical practice is very important. One ethical code by the bank has to be there. If you are dealing like for example, like what I told you, if your close relative or friend you want to give a loan or something, you must declare yourself. You must say that there's something like this, and then give it to your manager, give it to some other lending officer to handle that particular case, so that there's impartiality, and then ensure that there is no kind of undue treatment is given in getting that through, and every credit evaluation process is properly followed. In the other area, now this is about relatives, close relatives, and then your friends and all that, whose proposals you are handling. The other important area is that this happens, decisions wrongly taken because of other ulterior motives. The customer will try to bribe. The customer will try to give you, gratification. I don't call it a gift, it's a gratification. They can come and give an expensive gift. So they can come and give an expensive gift, and a phone they can buy and give you, a very expensive hamper they can try to give you. Like that kind of things customer will give. Now, you need to keep in mind, as a lending officer, as a bank officer, if you are accepting something from the customer and customer expects something in return, that is what we call gratification. Gratification is that, customer is gratifying you. He is giving you something. And then he thinks that, easily your loan, his loan will be passed, his, facilities will be passed, proposals will be passed. Whenever check comes, you will immediately pass and all that. You're expecting something and then giving you a gift. That's called gratification. So under normal circumstances, as far as a bank is concerned, as our code should be that we do not accept gratification, so that our decision will not be hampered by him giving us something and expecting something in return. It should be that if a token gift is given, you are taking, but at the next moment a proposal comes which under the bank's appetite and bank standard you can't give, you should be in a position to say no to that. That is what proper banking, that is what ethical and professional way of doing banking. But you know that in the market, it is infested with this kind of a unethical practice where the bank officers operating for the benefit of the customer. It's okay, you will have to work for the benefit of the customer, but then at the risk of bank, the loan becoming non-performing, at the risk of bank losing the profitability, or the bank falling into trouble. So that is something which is alarming, which you all should keep in mind. Ethics in lending is very important. Ethics in your practice, all the practices, as well as especially while we are talking about lending, ethics in lending is very, very important. Right. So some of the mitigatory factors here, if you see that your organization having a code, tell me how many of you have this ethics written down document in your organization. that you have business ethics. You are asked to follow the business ethics. So can you all tell me whether you have or not?
We have, sir, and there's a one clause that says in the festive season, if the customer gives below 10,000 rupees, that we may accept with a written note.
Okay, okay, right. That's great. Anybody else? Anyone else? Okay, you all are keeping quiet, huh? Don't want to consult, discuss or whatever. So, like what you say, these say, I mean, that's a good way of handling. Now, the expectation of the organization is that, okay, during festive seasons, customers may give hampers and all that. Okay, you accept the hampers or consumables or for eating. I mean, to consume. Gift of reasonable value. The expectation is that by getting that, you are not going to really support the customer. These are, goodwill things which are done. Okay, you accept it, but you don't go and change your decision just because, okay, that customer did not give, this customer gave, so I will favor this customer, that fellow I will not give. If that is your then problem. So that's the reason why your institution has put a limit there below this, about this you should not accept and all that, because customer also will not be happy if he gives something, if you just simply say no, I don't want. Also they may not be happy. That is about the customer relationship also. So they would like to give something out of they are continuously, we are year long, we are dealing with you, I want to give you something. So that's a kind of a thing, like you can't say no, but by accepting that also, you should not play into the hands of the customer. That's the expectation. So that's important. So this is this area basically nobody will discuss, because this is a little sticky area. But you must, as a lending officer, why I am telling, I have seen, I have gone through all these areas. I'm a lending officer, I'm a branch manager, I'm a country manager. I have gone through all that. I mean, people do. I mean, I have dealt with customers of every range. But this, I know that this is very important. This is one of the areas where lending officers fall into trouble. Many managers lose their job. All this happens because of this. So keep that in mind. Mitigatory factor is that keep that token gift giving is okay, but no gratification, where customer expects something in return. Number one. Number two, you don't handle that kind of a non-customers, close customers yourself. You take and then you declare that he is so and so, so this is given to so and so, and then you give it to some other lending officer to handle, right? Not to directly handle those things. And number three is that wherever you are getting, you must ensure that you are getting at a keep it at a gift level, not the gratification. Right. Any questions on that? Any questions up to that? This particular thing, week 6, I went slowly because that's very important, qualitatively very important area to tell you all. People who are in lending, of course, will understand. People who are not in lending may not understand that fast. That's why I went very slow and then kept repeating also, so that it goes to your mind very well. And I coupled a lot of practical experience. What I have seen, that's what is important, not a matter of teaching theory of these things. These kind of things, of course, in a couple of hours we can teach and go, no problem. But where you will come across these things is very important. What are the points you will encounter these things, and then what kind of safeguard you must have, and then so you must have a wholesome understanding in this area. That's the very reason I kept on repeating. Any questions up to now? Any questions? So tell me, shall I start with the next tutor? Do you want me to take it up with the next this one? Shall I start with the next one?
Okay, sir.
So next week.
Next week. Okay. Now, have you all started? The assignment? Can you submit before 15th? Now, on that, on the assignment should be submitted before 15th. 15th of Jan. I told you that assignment should be submitted to the this particular LMS, Learning Management System itself. You must upload it, and Mr. Menaka will give you instructions how to do that. So I will take a link from that and then I will correct it. I don't want you all to send to my, I have given you my email address. Please tell your friends also who have not attended the class today that the assignment should come to that. And assignments will be marked from Jan 15th. I will try and finish those assignments so that we can have the exam part organized. Otherwise this assignment thing keeps on dragging your completion of the particular course. So assignment I would like to complete. I will ask Mr. Menaka to give a link for me to check and mark the assignments. So assignment should start flowing in before 15th of Jan. 15th of Jan you should complete it. So that's important. That's point number one. The other point is due to Christmas, Institute will not be conducting the class next week. So next Sunday, no class. That means what? 27th, right? 27th, no class. So again, we will meet on the 3rd January, right? 3rd January, we will be having the next class. So we can follow up from there. So two things keep in mind. Next Sunday, no class. The other one, assignment you are submitting before Jan 15th. Make use of next Sunday also for this benefit and then completing your assignments. I have given you guidelines how to complete it. Don't go and overdo those things. Don't write things which are beyond the given kind of I can have a 5% tolerance. I can 5 to 10% tolerance I can have on the word count also. Don't try to go and copy paste things. I can also copy on the I can also go and check on the plagiarism. I told you plagiarism is that you all going and copying some from elsewhere and then submitting your assignments, which I can check. If I find that, I will disqualify. I will not take those assignments as valid assignments and I will disqualify. So plagiarism also you must avoid. Your own writing, I would like to, your own reading and then writing in your own words is what is important. If you are quoting anything from wherever you have taken, as it is, if you are quoting, it should be within inverted commas and quoted, and reference should be mentioned. So properly you must reference it, how you have taken, and then you must put the reference and submit the assignment. So that's about your assignment. That's about
excuse me. So, regarding this link, I didn't get it. Like it's a link that we have to upload our assignment.
Yeah, Mr. Menaka will give you the link for you to upload.
So we have to do it and upload into the system.
Yeah, you will have to upload it to the system. The link given by Mr. Menaka. He will give you. I'm telling you. I'm telling him today to send the link to you all. So do not send it to my personal email. You put it to that link. I mean, I will get myself a link for that, and then I will correct all your papers, all your assignments. Are you okay? You wouldn't have got the link so far. I discussed with Mr. Menaka. He said tell you all, and then he will inform you all.
Right, sir. Thank you.
Right. Okay. Thanks. Any questions? Any other questions up to now? I think we have covered a good amount of the course up to now. Lots of areas I have gone beyond the thing. Also try to explain, give you practical examples a lot, so that you will understand. There's a difference between somebody who will talk about theory and then practice, is that we are trying to give our experience. This is not, we are not trying to lecture you on a particular subject. We are trying to give you an experience. So practicing bankers, that's the important thing. You must know like what really a practical thing. So that's the importance I place. And unfortunately, I hope from the next session, I think your session may be the last for me. I may not be able to continue this course. So you all don't think that, I mean, you can do it next time you will do or whatever. This may be my last session. I may stop lecturing this session due to my workload. I have gone into a different this one, so that I don't have time. So this I have undertaken, I will do and complete. So that's why I want to have these assignments and all completed also, so that exam also I can talk and then see ways and means of completing that after completing the classes. So the people who think like, this time they studied, next time they will try to do exam and all that, will be a little bit disadvantaged, because next time lecturer, I don't know who will do and all that. That part. So rather better for you all to study and complete the course as much as possible. Not to keep arrears for the next time. You may be going under a different lecturer. Right. If you don't have any questions, anything to share with, shall we call it a day? Shall we meet up next time on 3rd? Okay.
Thank you very much, sir.
All right. Thank you so much for your patient listening.
Thank you, sir.
Okay.
Thank you.
Thank you, sir.
Okay. Thank you. Thanks for patiently listening. Please do talk also in future. I'd like to listen to your good voices. So please do talk. I love to be with the children, like with the class students while I'm doing a session. I told you all that I'm at a loss, sitting in a vacant room and then lecturing. But if you talk, that will make more interesting. So please. Right. Okay. All the best to you. Have a nice weekend. Enjoy your time, evening, and wish you a very happy Christmas and Merry Christmas, and then Happy New Year to you, all of you, with your families. Okay. Bye.
Thank you, sir. Wish you the same.
Okay.